Thank you.
Sir, you have stopped sharing the screen.
Yeah, we are going to share it again.
Okay.
Are you able to see it now?
Yes, sir.
Yes,
Yeah,
sir.
thank you. So any doubts up to the last class? Yeah, 1 second. Listen here. Yeah, yes, madam.
Sir, we are not able to hear you, sir.
Relevance is for how many years? So what is debenture?
We are unable to hear you.
You are not able to hear us? Online people, can you hear us?
Yes,
sir, we
sir.
are-
We can hear you.
Yes, sir.
That's not possible.
Sir,
Okay,
you are audible.
Some of
but
your classmate is asking a doubt. I'll just tell you there is a transaction in the assignment regarding debentures. So one of your classmate is asking about the interest on debenture, how it need to be recorded in the trial balance. Is it clear for those who are online?
Yes, sir.
So any answer from anybody? What is debenture?
So do we have to pay the interest or we have to receive the?
No, first of all, what is debenture?
We get money from? I mean,
It's a deposit from the public, sir.
Good. Yes, sir.
It's a deposit from the public.
Deposit from the public. Are you a bank?
No, it can be. We are not bank, but it's
Then
an.
how do you say that's a deposit? Those who are offline, those who are sitting in front of me, please listen to the discussion. No discussion among yourself. Yeah. Yes, sir. Are we a bank?
No, no.
Then why do you
So
say
it
it's
is
a
a-
deposit?
So it is a short-term or a long-term loan that in taken in instead of shares where we can give the dividend in a profit. Whereas in debentures is that we are like creditors, we have to pay them as a interest. So it is
Confusion, simple words. Why do you say so many things? Simple. What is debenture?
it's a long-term.
Sir, it's a paper of assurance.
One at a time. One at a time.
Sir,
It's
it's
a
a paper
long-term
of
lending to the
assurance.
company.
Long term
Lending to the company.
lending to the company. We are company, right?
Yeah. So it's a long-term loan we're taking from the public.
Long term borrowings.
A paper of liability.
Can we say it's a long term borrowings?
Correct, sir. Same thing.
Yes,
same
sir.
You
thing.
have to understand.
Borrowings, and in regards of that, the company pays back to the investors as an interest.
Can I say it's a long term borrowings? Simple.
yes.
Yes, sir. Yes.
Only 2 words.
Yes, sir.
Yeah, long
A
term.
document, a paper given by the company at the time of borrowing money from the general public for a long term. Suppose I am a company, I borrow 5 lakh rupees from the market. It's not only from single individual. 5 lakh rupees is collectively borrowed. One paper is 100 rupee. Okay, one debenture is 100 rupees. I'm collecting 5 lakhs rupees by selling debenture document. So it's a long-term borrowings. Whenever there is a borrowing, you have to pay interest. How many years it is? It is for 10 years. In the example, it is given, in the assignment, it is given 10 years debentures. What happens to the debenture after 10 years? The company has to give back 5 lakh rupees and get back the document what it has given at the time of issue of debenture. Interest is payable every year. The people will not wait for your 10 years to give back the interest. Every year they will be getting the interest, or sometime every 6 months also, at the agreed rate of interest. The agreed rate of interest is nothing but the name of the debenture. 10% debenture, 5% debenture, 12% debenture. This prefix of percentage to the debenture name is called as rate of interest, coupon rate. If it is 10% debenture, what does it mean? If you are having 100 rupees debenture with you, you will be getting 10 rupees as interest from the company. Company has to pay 10 rupees to the debenture holders at the end of first year. Similarly, at the end of second year, again 10 more rupees. Till 10 years, till the life of the debenture, that amount will be paid. At the end of the life of the debenture, the principal amount will be repaid. Repayment of loan. Now you are preparing for 1 year. One transaction is you are borrowing money by issue of debenture. That one entry you have to make. I'm talking about the assignment, because one of the classmates are asking about the transaction that is regarding debentures in the assignment. Then at the end of first year, you have to pay interest for the first year. These two transactions will be there in the particular first year. Second year, once again. Second year, only interest payment. Third year, again interest payment. 10th year, interest payment plus repayment of principal. Is it clear, madam? She wants the answer also. As a loan, as a debenture. Yes, sir. Something you are asking.
Can you?
Interest is not paid. Okay, but interest is accrued. Say, for example, 1st January 2023, you issued a debenture. 1st January. The first interest is due on 31st December 2023. 12 months. But you are preparing a trial balance on 31st March 2023. Within this time period, only 3 months over. Those who are online, please mute yourself. Okay, 3 months interest is payable, but you did not pay any interest so far. There is no transaction. But when you prepare adjusted trial balance, that time, the 3 months rent you have to get. How do you write it? Interest on debenture account, debit to interest on debenture account, interest payable on debenture account. How much more amount? Suppose 10,000 is the total amount. For 3 months, it is 2,500. That is not an entry on payment. That's an entry on due. Because when you prepare the profit and loss account, when you calculate the profit of that particular year, interest is an expense. If you don't consider this 2,500, your profit is inflated by 2,500. That is not correct. Though you did not pay, you have to consider how much is payable for that period. It's a concept of periodicity concept, periodicity or accrual concept. In both the way, you have to consider this. But there is no payment. Cash is not paid. 31st December, you will pay cash or you will release the amount from the bank. That time, interest on debenture account debit to bank. That should be the entry. Okay, clear? Right. Any other doubt? Those are online. Any other
No,
doubt?
No, sir.
Okay. Anybody? So what do you mean by financial statement? What do you mean by financial statement? What is the purpose of accounting? Financial accounting purpose. Sorry?
Sorry, your voice is break. Your voice is coming on and off, sir.
Hello,
My voice is coming on and off.
hello.
Is it okay now?
Yes, sir.
Is it on?
Yes, sir.
I ensure that it won't be off.
Hello, sir.
All right. I'm just standing near the system and talking. You all can mute yourself.
Hello. Financial statements are for understanding performance and position of the
So much of
company.
disturbance.
Hello.
Yes, sir.
Too much of disturbance.
Hello, sir. Interest payable means current liabilities or expenses, sir. That's a group.
Interest payable is
Means you told interest payable is for accrual account. No, that is coming under current liabilities or expenses.
interest payable is a current liability.
Okay. In DB it comes credit side, no, sir. Trial balance.
Interest payable will come under trial balance credit side. Yes.
Okay, sir.
Yes. Anyone can speak from online. That's a problem. Can you please help me with the technical person who is there in that? All right. So anybody here sitting here has any doubt? Yes. Okay. Some sound is coming from their side. So, anybody can speak from online now?
Yes, sir.
Yes, sir.
So it's fine now.
It's fine now.
Yes, sir.
Yes.
Just wait. Can you hear me now?
Yes,
Yes,
sir.
sir.
Okay. Okay. Thank you. All right. So, purpose of financial accounting. What is the purpose? What is the objective of financial accounting?
Tells
To
us the
know the business
performance
health,
and position of company.
know the business health,
One at a time. Yes, madam. Once again.
Performance and position of the company. We get to know from it.
to get to know the overall picture or the health of the business.
It's a first class. Are you all guessing and telling something? Please tell me what is the objective of financial accounting? What I told you, please tell me. Okay, what is the financial objective of financial accounting according to our class? To know the financial performance
and
Performance
position.
of an organization.
of an organization. Then
Position of the organization.
two objectives.
Yes.
To take important decisions.
It is a financial position and financial performance.
Why do you many things? I know you are all creative, but in accounts we don't want your creativity. Keep your creativity with you only. I'm little worried about your understanding. Why you say always so many? Then for that you did not attend a class. Of course, everything is there. Anything. The help of accounting. I'm not denying. But something I was teaching you, right? I was telling you, right? We have a confined to we are confined with certain things.
So the objectives of accounting, you mean, right?
Yeah, I was asking.
Yeah, it is
Is
like
the
to maintain
objective of
record,
accounting, financial accounting.
which you taught last. If objectives of
Yeah.
accounting, which you taught last class was the previous class was like to maintain records of business,
Okay.
to know the results of business,
Okay.
profit or loss,
Okay.
to ascertain financial position,
Very good.
and to make information available to various other groups.
Very good. These are all the objectives. Correct? Excellent. You are telling from the PPT. Very good. But yes, yes.
Sir, I have
From the
noted
class,
all
yes.
my notes,
From the
sir.
class, I appreciate you that you learned from the class.
Thank
Correct.
you, sir.
But among these, very important objectives are two. Very important objectives are two. What are they? To find out the financial position of the business and to find out the
Performance.
financial performance of the business.
Business.
Okay.
Yes.
These two are the main objectives. To achieve these objectives, we have some ancillary objectives to maintain the records. After knowing about these two things, what are you going to do? I'm going to let these two information to the needed people, stakeholders, all the stakeholders who are all interested in the business. The first and last is an ancillary objective. The main two are in between. That is financial position, knowing the financial position, ascertaining the financial position, ascertaining. What is meant by financial position?
How is the organization doing in the market?
Yes, madam.
How the company is doing in the market? The
For that,
finan-
you have to go to market and check. How do you do it from
No,
your
no.
accounting records? Please
Sir,
understand.
Sir, it is a
Don't tell
balance.
anything out of your imagination.
Got
Sir,
you.
it is a
Last time I'll tell you.
Sorry.
Financial position means only three things.
Cash
Sir,
flow, income statement, and balance sheet.
Okay, wait for a minute. For us, only three things are nothing but financial position. So what is your financial position? It is something about asset of the business, liability of the business, equity of the business. Assets should always be equal to the total of assets should always be equal to total of liabilities and equity. Okay. So we are going to ascertain how much is the total asset of the business as on a particular day. That day is called as last date of the accounting year, 31st March, happening to be 31st March of every year. What is the total liability of this business? What is the owner's contribution to this business? Owner's money in this business. Okay. So owner's contribution to the business plus loan I borrowed from outsiders, put together the total resource available for the business to spend. Will you agree? Understand from a basic layman's point of view. Don't think it too much. Simple. Accounting is very simple. Don't make it more complicated. Simple mathematics. A is equal to L plus E. That's all. A refers to asset, L refers to liability, E refers to equity. Suppose I am starting a business by investing 1 lakh rupee from my family asset to the business. I brought 1 lakh rupee from my personal savings and I'm starting a business. Just now I'm starting a business. 2 o'clock in Bangalore, I'm just investing 1 lakh rupee to start my business. Now, what is the resource available in my business? Cash 1 lakh rupee. Cash 1 lakh rupee. Okay, I'm just asking my friend, 1 lakh is not enough to do my business. Can you give me 4 lakh rupees loan? He is giving 4 lakh rupees loan to you. Now the total resources available in the business is 5 lakhs in cash. Cash in hand. You are having 5 lakh rupees hard cash.
Yes.
Asset. Asset is 5 lakhs is equal to 1 lakh of equity plus 4 lakh of liability. That's all. Now you are going to do so many things from now onwards. You are going to do so many things in your business. You are opening a bank account. You are buying raw material. You are taking a building for rent. You are doing so many things. At any point in time, if you derive this equation, it should be equal. Assets of a business at any given point in time should be equal to the total of liabilities and equities, whatsoever it may be, whenever it may be. It's a basic accounting equation. To know this accounting equation, to know the numbers, to know the values for this, we do accounting. See, first day, okay, we are come to know 4 lakh plus 1 lakh is easy. If days are going on, you do so many activities. Final day, owner coming and asking you, sir, what is the asset of the business? What is the liability? How much I have to pay to outsider? How much is my money in the business? I gave 1 lakh rupee in the business. Is that 1 lakh rupees as it is 1 lakh, or it has grown, or it has eroded, reduced? For that, I should have an answer. That answer is outcome of accounting. By preparing a statement called balance sheet. By preparing a statement called balance sheet, the accountant is able to explain how much is the total assets of the business and how much is the total liability of the business and how much is the equity of the business. Clear to you? The first objective of accounting is to know the financial position, to ascertain, to calculate to find out the financial position. Please inculcate these words into your mind. Financial position. Don't say anything apart from these two words, financial position. Financial position refers to the status of assets, liabilities, and equity of a business on a particular point in time. That's all over. Clear? The second objective, the very second objective of business, accounting is to know to ascertain to find out the financial performance. What is financial performance? Financial performance is nothing but the comparison of income and expenditure of a business for a period of time. Financial position is on a particular point in time. On this second, this microsecond, my financial position will be 1 lakh plus 4 lakh is equal to 5 lakhs. The very next moment when I do some other transaction, when I involve in some other business activity, my financial position will change. The equation will change. Okay, but here, financial performance for 1 year or for a particular period of time, maybe 3 months. Sir, I want to know my financial performance for last 3 months. I don't want to wait up to 1 year. Mid-semester examination, monthly test, half-yearly examination, quarterly examination, just like students are having in their classes, business also can come to know what is the financial performance of it over a period of time, not to wait for 1 year, but at least 1 year, maximum 1 year, you should know. Within 1 year, if you want to know multiple times, you can. Sir, I want to know every month, you can do. You can come to know. Sir, I want to introspect myself, whether I'm going in the right direction or not. I want to know. You can calculate, no problem. But compulsorily, you should calculate your financial performance at least once in a year. That's called accounting year. On 31st March 2023 or 24, 25, we have to calculate. 31st March of every year, we have to calculate. What we are calculating? We are just calculating total expenditure and we are taking the total of income, comparing with each other. If income is in excess of expenditure, we say that as a profit. If it is other way around, we call it as loss. Profit or loss put together only we call it as financial performance. This is known by preparing a statement called profit and loss statement. Clear? Two statements come under financial statements of a company or a business. One is profit and loss statement. Another one is balance sheet. Two are having its own purpose to achieve, own purpose to serve. One is balance sheet is giving us the detailed picture of financial position of the business. Profit and loss account is giving a detailed picture of financial performance of the business for a period of time. Clear? Now, these two statements we are going to prepare. As an accountant, we have to prepare, or as an analyst, we need these two statements to analyze, to fix relationship, to find out deeper insight about the various accounting data, what is found in these two statements. Clear to you? Only 5 items broadly found in these two statements. Liability, equity, assets are found in balance sheet, income, expenditure, and the difference between these two are found in profit and loss account, profit and loss statement, otherwise called as income statement. Clear to you? The purpose of these two, one is to know the financial position, another one is to know the financial performance, accountant point of view. But as an analyst point of view, whether that financial position is okay. Sir, you are having a financial position just like this. Is that okay for you? Is that advisable for you? Is that contented for you? Is that okay? Is that having any problem? My competitor is having a financial position better than me. But I was having a financial position better than this year in the last year. One is inter-firm comparison. You yourself comparing with yourself only. 2022-23 financial performance and financial position. You are comparing with 2021-22 of your own. Current year performance or financial position is compared with previous years of your own. Are you growing or not? Are you going in a growth path or not? That you are checking. Another one is you are comparing yourself with your competitor. That's called inter-firm comparison. Inter-firm. between the firms, between the companies. First one was intra-firm. Intra-firm means within the firms, year on year comparison. Okay, we'll come to that little later. Now, how to prepare it? Two reasons for learning this. One is you yourself have to prepare. If not, you are not an accountant. You yourself should know how you can read these two statements. How do we take data from these statements? How do we use it for analysis? To find the deeper insight of the company. Clear to you? Now, based on this, we already talked about the format of financial statement. That is balance sheet as well as profit and loss statement. Understand one concept very clearly. Whenever you are a company, when you are a company form of organization, you should prepare these two statements according to Indian Companies Act 2013 format given to you. The format is given by these Companies Act. Each and every country will have its own format, more or less similar. If you are not a company form of organization, sir, I am not a Wipro Limited. How do I know it's a company? The limited letter, the word limited will be there at the end of the name of the business. Wipro Limited. Okay, Tata Consultancy Services Limited, Infosys Limited, HDFC Bank Limited. If it is ending by limited, then it is called as company. It got registered under Indian Companies Act 2013 or by any other previous act in India for companies. If that is the case, you have to prepare only in this format. We as a student of accounting or a student of accounting for manager learn about only this format, not about the sole trader, partnership or any other thing. But rules are same. How do you display the format? How do you display the items? That only differs. Okay, this is called a statement. Look at this. It's called a statement. It is not in a T form. What is T form? T form means there will be two sides. One side is debit side, another side is credit side. One side you will write expenditure, one side you will write income. In case of profit and loss account, in case of balance sheet, one side you will write assets, another side you will write liabilities and equities. That's called T form. English letter, capital letter T. Okay, bold letter T is there, no? So we call it as a T account. T account means an account is having two sides called ledger account. Ledger account. Debit side, credit. Last class we discussed T form. Without saying the T form, I told you ledger account, cash account we prepared. Okay, you remember? So T form. That is okay for sole trading company, sole trading concerns and any other form of organization, not for company form of organization. Okay, just for a glance, go through this balance sheet. Balance sheet contains only three items. One is liability, equity, and assets. Okay, first part of the balance sheet talks about equity and liabilities. Balance sheet has two parts. Like the equation. The equation has two parts. Now, one side is asset and one side is asset, another side is liability and equity. Same equation, we're putting it in a statement form. That becomes a balance sheet. Okay, look at this balance sheet. Yeah, equity and liability. First item under equity and liability is shareholder fund, share capital, reserves and surplus. Then non-current liabilities. This first one is nothing but equity. These two are called as equity. A and B are called equity. Then these two are called 2 and 3. Number 2 and 3, what I mentioned over here is called liability. But for our own convenience, Government of India through this act, through this statement, they are telling you to classify the entire liability into two categories. One is current liability, another one is non-current liability, short-term liability and long-term liabilities. Okay, so current liability and non-current liability. Right. The total of these three, total of shareholder fund. Shareholder fund is otherwise called as equity. Shareholder fund is nothing but equity. Net worth, equity, shareholders fund, owners claiming the business, all are same, one and the same. Okay. Then second part of the balance sheet is assets. Look at this. Total of shareholder fund, total of non-current liability, and total of current liability. Put together this total. In our example, it is 5 lakhs. In my small example, I told you, owner contributes 1 lakh, borrowed 4 lakh rupees. So it is 5 lakhs. Shareholder fund 1 lakh. Current liability nil. Long-term liability is 4 lakh. Right. Next. That 5 lakh is for now. Next moment it may change. Next moment you might have borrowed some 1 more lakh. It becomes 6 lakhs. Next moment you might have given 50,000 rupees repaid to the loan giver. It becomes 4.5 like that. Yes. Okay, it can be current also. If you told your friend that you are going to give back after 10 years or after 3 years or after 2 years, it is a non-current. He was giving you 4 lakh rupees, just give me next month, then it is current liability. That's all. It depends on the terms. Suppose you are borrowing a loan on 31st, sorry, on 30th December, 30th March for 1 month. Is it a current or non-current? But you are going to repay in the next financial. That's not a, it's not a year. It's about the nature of the loan, nature of the due, nature of the obligation. If the obligation is having less than 1 year period of time from the date of starting the obligation, from the date of committing with an obligation, you are borrowing today and you are going to repay after 11 months. That time also it is called short term, current, 1 year, maximum period of 1 year. But it's not about one accounting year. Current accounting year you are borrowing. Next accounting year only you are going to settle. Though it may be, it's a current liability depending upon the duration of the obligation. Maximum of 1 year current, more than 1 year is non-current. Okay. So now look at these assets. So assets on this particular day, what are the assets are there? Fixed assets and then current asset. Under fixed asset also, sorry, under non-current asset also we have 2. One is fixed asset, another one is non-current investment. Asset means building, land, plant, machinery, motor vehicle, equipments, etc., etc. Okay, that is called tangible assets. Tangible. Then intangible. What is intangible? Which cannot be seen. There is no physical form for that. Goodwill, patent, trademark, copyright, then franchisee. All these things are example for intangible assets. Okay. Next, capital work in progress means you bought a land and you are just constructing a building. Then this one is you are doing a research and you are going to get a patent for that output of the research. If anything of that nature is there, what is the value of those things? That will come under these 2 categories: capital work in progress and then intangible assets under development. You are doing a research. Suppose you are a pharmaceutical company, you are doing a research to find out a new medicine. Okay, after doing that, after testing everything is over, you will get a patent. That time it will have a value. That value as of now, how much we are writing it here. Okay. Normally it won't be there in general, but if it is there of that nature in your company, you have tried it. That's all. Next one is non-current investments. Your money invested in some other place, but it's for long-term purpose. 5 years bank deposit you have done. 3 years bank deposit you have done. Or you bought the debentures of other company. That all comes under the category of non-current investments. Your money, company's money, not required right now. That is invested in outside the company, maybe a bank, maybe another company, maybe any other financial institutions, etc. Next, tax, how it is asset, liability also it was the tax. If you paid tax in advance, that's called asset. If you are still payable for tax liability, that's called liability. Tax payable liability, tax paid in advance is asset. Okay. Long-term loans and advances, what you gave to others, that comes under asset. Long-term loans and advances, what you taken from others will come under long-term liabilities. Okay. Next one, other non-current asset. Anything out apart from these, but that is not a current also nature, that comes under other non-current assets. Say for example, preliminary expenses unwritten off. Okay, preliminary expenses or any other such nature. Okay, discount on issue of debentures, discount on issue of shares will come under this category called other non-current assets. Next one, current assets. Current assets are nothing but those assets which are converting itself, which are getting converted itself by virtue of business into another form very often or within one accounting period of time. Example, stock, cash in hand, bank account. These are all the example for current assets. Current assets. Look at this. We have category also here, current investments. You have invested your money in some of the companies or some of the banks for short period of time. That's called current investment. Then inventories, closing stock of raw material, closing stock of finished goods, closing stock of work in progress, closing stock of stock in trade. Everything comes under inventories, closing stock. Trade receivable means sundry debtors, bills receivable, accounts receivable, etc. The customer from whom we have to still collect the money for the sales what we made so far. Check, cash and cash equivalent, bank balance. Cash in hand and cash at the bank. As on today, how much cash is available in the company and how much cash is there in the bank in the name of the company's bank account. Next, short-term loans and advances the company has given to outsiders. Customers might have taken some advance from the company. Supplier might have taken some money from the company as an advance supplier to supply the raw material. Okay. Other than this, anything else is there? Other current assets will come under. Suppose you are having a interest due from the bank but not received. Interest earned but not received. All those things will come under other current assets. Okay. So this is the format of balance sheet, and look at the format of profit and loss account. Revenue from operation. Yes, madam.
Hello, sir.
One second, sir. Some of your friends is asking.
Sir, what about surplus and one more liability side mentioned? Surplus and one more in balance sheet, sir.
Yeah.
Surplus.
Under
What is
equity, you are asking.
Yeah.
Shareholders fund. Point number A, share capital. Point number 3 is reserves and surplus.
Yes, sir.
Reserves and surplus means the money what is earned by the company as profit but not given to the shareholder.
Sir, some disturbance is coming, sir.
Some problem is there.
Yes, sir. I can't hear you.
Okay, please mute it. I'll tell you the answer. Yeah, I got the question. Yeah.
Okay.
Yeah. So you are asking about the second item in the balance sheet under the shareholder fund, that is reserves and surplus. Reserves and surplus means the amount that is profit up to current year is called reserve, not distributed to the shareholders. Okay. Surplus means current year how much you are getting as
So
profit.
your voice is not clear.
Is audible, sir.
So sorry, wait.
In the mic, sir, some problem is coming.
Oppo A5.
Yes, Oppo A5 has to go on mute.
Arpita Biswa.
I have muted myself.
She's doing before that, she's telling me. Don't worry. Yeah. Now is it okay?
Yes, sir, it's
Sir,
good.
no, we didn't listen anything. Can you please repeat?
Okay, okay, I'll tell you.
Yeah.
Reserves and surplus, somebody is asking. Reserve means the amount, accumulated amount kept in the business out of profit. Suppose in 2011 or 2020, the company earned a profit of 1 crore. 40 lakhs were given to the shareholder as dividend, 60 lakhs retained in the business. 2021, again one more 60 lakhs. 22, another 60 lakhs. For 23, the surplus, the reserve is 1 crore 80 lakhs. The surplus. Suppose in 2023 also there is a profit, 1 crore, 60 lakhs you are retaining, 40 lakhs you are giving as dividend to the shareholder as usual. Now the reserves and surplus put together will be 2,40,000. 1,80,000 was, sorry, 2 crore 40 lakhs. 1 crore 80 lakhs was the reserve up to 2023 end, without you calculating surplus of the current year. Surplus is again 60. Reserves and surplus put together is 2 crore 40 lakhs. Suppose you are giving all the profit as dividend, there will be 0. Okay. Then current year, all the profit you are giving, surplus also 0. So reserves and surplus column, here you will write only. That's all. Is it clear? Once again, I'll tell you, reserves up to last year plus how much you are transferring reserves for the current year from the current year profit is called reserves of the current year. In my example, 1.8 was the reserve. Current year after last year. Current year, you are transferring 60 more lakhs to the reserve. It becomes 2,40,000. And again, reserves and surplus both are different. Suppose you are keeping some amount as surplus only. Surplus only. You are not earmarking as reserve. That's called just surplus. Surplus means just a profit and loss account undistributed. Profit undistributed is called surplus. Reserve means the profit earmarked for some purpose is called reserve. Reserves and surplus. Clear? So next one, profit and loss account. Yeah. Okay. To answer this question, I ask another question. Sir, listen, some disturbance. Any annual report you are preparing for your company? No. Here, weekend report, nothing. No, right? Week starting report, nothing. Okay. So, madam, you are asking question. What value I would write in terms of that particular item? All intangible assets. If I want to write it in balance sheet, it should have some value. You are right, but question is, from where you are getting data for preparing these two statements? You are not arbitrarily preparing these two statements. From where? From? That's a great answer, no? Books of account. Where do you live? Sir, I'm
Trial
living
balance.
in the earth. Please be specific, madam. Where do you live? Suppose you are in America. If they're asking you, where are you from? You can say India. I'm from India. That makes sense. If you're in America. If you're in Bangalore, if I'm asking you, where are you from? He's telling, sir, I'm from India. That much general answer is not required. Little more specific. Okay, I'm from Jayanagar. I'm from Electronic City. That much is required, no? So that much specific. Books of account is very common. Everything is coming from books of accounts only, right? Yeah, then? Huh? Ledger and trial balance? Why two? Trial balance only. So one item which is there in the trial balance with value only we are taking to balance sheet. So there is no doubt of that is arising. I am giving you trial balance. I am giving you trial balance. From trial balance, whatever is there in trial balance only is going to be placed in balance sheet or in the P&L account. Please understand. 5 items can be there in the trial balance. There are so many, but major heading is 5. What is that? Liability, asset, equity, income, and expenditure. Anything, you find anything in the trial balance that should fall under any one of these 5 categories. That's what. Anything you name or anything you find under trial balance, in trial balance, that should any one of these 5 categories. Example, rent expense, salary, land and building, okay, interest, interest paid, interest payable, receivable, sales. He's asking some question. What? Sales is sales, sir. That. Income, purchases. Now only expenditure. Again expenditure. Purchase expenditure. Okay. Motor van. It can be. In a normal parlance, it can be. But in accounting, in trial balance, we are talking about trial balance items. In trial balance, if I find anything called purchase account, that means purchase of material only. If you are purchasing a machine, what entry will make? Machine account debit to cash. Then in trial balance, only machine will be coming and sitting there. Purchase won't be there. Purchase is the head of account, which I'm giving to only for material purchases. That's all. Okay. Like these, there are so many items. Goodwill. Goodwill, asset. Trademark, asset. So each and every item, what is there in the trial balance, will have some value mentioned against it. So we need not worry about in this stage. Okay, after coming in, sitting in MBA, I should not worry about will I know ABCD or will I know grammar. That's all understood that you know. So trial balance is the one which is in front of us. From that, we are taking the values. So who should worry about that? The accountant, when he is going to record goodwill account debited to cash account. Suppose I'm going to buy a goodwill. Can you buy a goodwill? You cannot buy? Yeah. You can buy. Where you can buy? Which shop? Yeah, when you acquire a company, if you pay more than the real value of that company, the excess what you're paying is called goodwill. You are buying a company as an ongoing company, which is worth for only 5 crore, but you're paying 6 crore to buy it. You bought it. Now, the 1 crore what you paid extra is called as goodwill. Business purchase account 5 crore, goodwill account 1 crore, to bank account 6 crore. That's how your entry is getting satisfied. Double entry bookkeeping. So this 1 crore goodwill you're buying. Suppose, can you go and buy a goodwill alone from a shop? Sir, I want 1 kg goodwill. No such possibilities. So goodwill is coming along with a business which is bought. Okay, in that way, goodwill is coming. Now the accountant should be worrying about whether should I pay this 1 crore or not for this business to buy. That is top level management will decide. Accountant will just record. Management is telling you, sir, we bought this business by spending 6 crore. These are assets. These are liabilities coming from that business. It's a running business, right? Running business. Their balance sheet is given to you. And you are asked to record it in the business. Now we paid 6 crore. This is a balance sheet. This is a business I bought. Now you as accountant is going to decide how much is to be written under goodwill. That time you have to worry about this value. This is called valuation of goodwill. Valuation of intangible assets. That's not a subject matter of our class. That's separate. Valuation. If you take finance as a specialization, you can read about that later in your 4th or 5th trimesters. Okay, that's called valuation of intangible assets. But now, as of now, it's very simple. What is there in the trial balance? You take and write it. That's all. Any doubt? Yes, madam? Anything? Yes, sir. Sorry, okay. Maybe 3rd or 2nd trimester, right? All right. Next one is income. 2 incomes is possible. That is sales revenue and another income minus all expenses. Last class we discussed detail about this. So no need discussing again. We can take one small
I have a question.
number. Yes, sir. Anything? Anybody is saying something from online?
So, sir, without this trial balance and all, can we able to prepare this balance sheet?
How do you do it? Without
I'm just
add
asking.
2 numbers. Without 2 numbers, how do I add 2 numbers? Your asking question is, can we prepare a balance sheet and an income statement without a trial balance?
Yes. Suppose if we
cannot
have
do
some
right.
set of suppose if we have some set of transactions which has
Friends,
all
please
the
listen to your
company-
friend's question. Yeah.
Suppose if we have some set of transactions which will actually give the details of all the company financial statements. So with that reference, can we, is it possible to prepare? Just want to know.
You can do it, but you have to prepare a trial balance for that. No.
Okay.
It's a process, right?
Yes.
It's a process. Journal, ledger, trial balance, then financial statement. What you are having with you, some information you are having. That information need to be brought into journal first.
Okay.
Then it should go to ledger. It should go to trial balance. Then only you can prepare balance sheet as well as income statement. That's a process. That's a sequential process, one after another. You can prepare balance sheet and income statement without trial balance. Yes, of course, true. You can do so, but roughly you have to prepare a trial balance again. Those days, these people, small traders will be there now. They won't maintain any books of account. Even today, some small traders. This GST only is making everybody to compulsorily follow certain procedures of accounting. Otherwise, people are not following accounts. They themselves know what they are doing. Suppose only 1 crore is my total turnover in 1 year, 1 crore. I know why 5 vendors will be there for me, 10 customers will be there for me. I just maintain a books of account in a diary. No need of T account. Just I write Ramesh, how much I sold, how much I received, sold, received, sold, received. At the end of the day, take a total, plus minus. If plus is more, I have to receive from him. If minus is more, I have to give to him. That's all over. That kind of people still there. But those people will supply all these data to an accountant. That accountant will just again prepare the trial balance. Without trial balance, see, trial balance is checkpoint for checking your arithmetical accuracy. If you do balance sheet without trial balance, if there is any mistake, you cannot identify. So it's not advisable to do. And again, we are talking about a bigger companies, Tata Motors, HDFC, all those people are having numerous number of transactions in a year or even in a single day. So there is no point of forgetting about trial balance and preparing the statement, financial statement directly. No point. Okay.
Okay.
Look at this trial balance. There's a trial balance given to you. First item is share capital. 2,000 shares of rupees 100 each, 2 lakhs. How this is coming here into trial balance? Long ago, sometime when the company was started, the company went for IPO. They collected money, 2 lakhs, by selling 2,000 equity shares of rupees 100 each. It is not just in this year. Maybe in this year also, but not necessarily to be in this year. It is an outcome. It's an accumulated figure. As of now, how much is there? Okay. So 2 lakh is equity share capital in the name of 2,000 shares of 100 each. Again, 10,000 shares of 10 each is there, 1 lakh rupee. Reserve fund, 2,50,000. Like that, there are so many items. Now let us discuss one by one. Where do you record this first item? In balance sheet, under shareholder fund, in the name of share capital, you have to write how much? 3 lakhs. 3 lakhs. Clear? Then reserve fund. This under reserves and surplus, you have to calculate reserves and surplus of current year by taking this as a base. This is opening balance of reserve for this year. How much reserve you are taking from the current year profit? Suppose you are taking 50,000 rupees from the current year profit. What is current year profit? I'm going to find out in the profit and loss account. Okay, suppose that is 50,000. Not all the profit. Profit was 5 lakh. But management decides to transfer only 50,000 rupees to reserve 50,000. So reserve will become 3 lakhs.
Sir, excuse me. If it is an the reserve fund is made out of the profit. That is fine.
Out of the profit, yes.
Yes. If it is a new business, okay, this year what we are starting, then reserve fund should how should be treated? That it should be treated as an from our investment or no reserve fund. How to do that?
Madam, if you're starting a business today only means you don't have reserve. That's it now.
Correct. But if you want to reserve for some depreciation, reserve for depreciation or any loss, then
you are confusing. See, just now we are defining what is reserve. Then why are you bringing unnecessarily one guest there? Depreciation. Have you understood what is reserve?
It's a future expense.
What is reserve according to you? Just now I explained to you what is reserve. What is reserve?
It's on future expenses for on.
That's what you are thinking. Just now I defined what is reserve, no? What is reserve I defined? The profit of the business taken and earmarked, labeled as reserve for some purpose. Suppose in 2022, your profit was 1 crore. Management is conducting a meeting, board of directors meeting is happening. The board decides out of this 1 crore, we will take 20 lakhs as reserve. This reserve is for any purpose. If it is called general reserve. If it is for specific reserve, you have to name the purpose of the reserve. Workman compensation reserve. Your business is hazardous in nature. Mining business. You are doing a mining business. Workmen may have some kind of problem, accident in the mining. To compensate them, there should be a reserve. So current year, your profit is 1 crore. In future, you are expecting there may be any problem for my worker, which may require my business to compensate that particular risk. So I want some money for that. I cannot take money from that year's business. Because this year, no accident. I cannot say that this won't happen the next year also. So I just take some amount and I label it as workman compensation reserve. Another reserve. Suppose you want to give stable dividend for your shareholders. 1 year you are giving 100 rupees as dividend for 1 share. Another year you don't have profit, you are telling no dividend for this year. That time shareholder may get disappointed. So you want to stabilize the dividend payout. Every year I want to give 30 rupees minimum as dividend. So what do? You take some reserve. You create some reserve from your profit of the profit year and you keep it as a reserve. That's called a dividend equalization reserve. You use that amount at the time of shortage of profit to compensate the amount of giving dividend. That's called dividend equalization reserve. Okay, don't confuse with other terms. There are so many reserves like that. You can create n number of reserves depending upon your company. And again, there are some statutory reserve. If you are an export-oriented company, you are dealing with dollars. Okay, dollar values are keeping on changing. Okay, that time you have to keep one reserve called exchange rate reserve. Exchange statutory reserve. Company law is itself telling you have to keep some amount as reserve. You should not consider all the profit as profit of the business. So these are called as reserve. So reserve means anything that is created out of profit. Reserve is nothing but out of profit. Appropriation of profit. Appropriation. We are filling the tank of the car or bike. When the reserve will be available, if you fill the tank, only reserve will be available. You don't fill the tank, just you bought the car, new car. Without even petrol, you're just having the car. Can you have a reserve? No. The reserve is out of profit. Okay. Provision is against profit. Depreciation, provision for depreciation, all these things are against profit. If you have profit, you can have reserve. If you have provision, your profit will come down. Provision means what? Charge against profit. Expenditure, kind of future expenditure. For that, you are keeping some amount, taking away from some amount, but not after calculating. Irrespective of profit or loss, you are keeping some amount aside. That is called provision. Provision for bad debts. Provision for bad debts is an example for provision. Okay. So these are all the points you have to remember when you are preparing a balance. Profit and loss account. Provision, you have to write it in expenditure column. Provision. Okay. Anything? I think we are not able to finish this in this particular 6 hours also. Huh? Okay. Anyway, if you are understanding something, I'm happy. All right. So,
Sir, wait. BR and what is BR and BP?
I'm so sorry. That is bills receivable and bills payable. Okay. I'm sorry. I have written very shortcut. Bills receivable and bills payable. Meaning you are selling your goods to your customer on credit basis and you are getting one document from him for a safety purpose. That document is called as bills receivable. At the same time, you are writing some document and giving to your supplier when you are buying goods on credit. That time it is called bills payable. Bills payable is a liability. Bills receivable is a asset.
So like you have written here in returns now 15,000 and 20,000. It would be like purchase return and sales return.
Yes. Credit side 20,000 is purchase return. Debit side 15,000 is sales return.
Yeah, it's quite confusing to see it.
What is
on
confusing?
Like on both the sides.
Return.
No,
Sorry?
on the both side, return on the both side, debit and credit, unless and until we will not mention it's purchase return or it's sales return. For me, sir, not for you actually.
No, it's not for everybody. It should not be confusing. Why it is confusing? Debit side, some amount is there. How much is there? 15,000 is there. Is there any confusion in that 15,000? We understand return, debit, 15,000. Is that okay? In that, no confusion?
Yes.
Similarly,
Sir.
return, credit side, 20,000. Any confusion? No confusion. Next level, what you understood about return. That makes clarity. Right. Returns in debit side. Sales, which side always? Credit. So sales return should be in. So return in debit side is sales return. If you know one, the another one is opposite. Purchase is always in debit side. Purchase return should be in credit side. That's all. Okay. In question, if I give like this, you cannot tell that's confusing. You should know the logic. Okay. Accountant, why they're writing like this is writing in 2 sentences. They're writing in only 1 sentence. Returns. That's all. Okay. Otherwise, return inward and return outward. That time also, if you're confusing, means you should know what is written inward and what is written outward. Okay. Simple. Return in debit side is sales return. Return in credit side is purchase return. That's all. That you should understand. Okay. Fine. So this building, where you'll write it? Balance sheet, asset side. Fixed deposit in credit side, it is there. Liability.
Sir?
Normally, fixed deposit you keep in a bank is asset. That should be in debit side. Asset will always in debit side. Okay. You know that logic, no?
Sir.
Asset, expenditure, loss, debit balances. Income, gain, liability, credit balances. Okay, in that way, just fixed deposit is an asset. If you don't know this debit credit, you have to see there. So it is in credit side, so it is liability. Suppose it is given here 1 lakh in the debit side, then it is asset, not current asset, fixed asset. Salary, profit and loss account item, expenditure. In profit and loss account, expenditure side, you have to write it. Next, machinery, balance sheet, asset side, under fixed asset, under which asset? Tangible asset, you have to write it. Asset, first balance sheet, asset, fixed asset, tangible asset. Next, furniture, again, same thing. Balance sheet, asset, fixed asset, tangible asset. Again, look at this. Here also it is given together. Purchase and sales. Debit side is purchase and credit side is sales. Both should go to statement of profit and loss. Sales. Sales is the first item in the profit and loss account. Look at this answer. Look at this. Revenue from operation. How much was the sales? No. How much was the sales? How much was the sales? How much was the sales? 5,25,000. How much was the return? Return how much? 15,000. So net sales is 5,10,000. Look at this. It is written over here. A small workings you can make. Small workings you can make. Sales is 5,25,000. Look at this. Minus sales return is 15,000. So the net sales or revenue from operation is just 5,10,000. That is written over here in the profit and loss statement. Okay. 5,10,000. Yeah, 5,10,000. There is no other income. So nil. The next one is total revenue is just 5,10,000 minus all expenditure. First expenditure is material consumed. Material consumed means opening stock of raw material plus purchase of raw material minus closing stock of raw material. In this question, there is no purchase of raw material, closing stock of raw material. This company is a trading company. How do I know? There is no raw material purchased. But there is one purchase. That purchase is nothing but stock. Purchase of stock in trade. Okay. That is why it is given nil. The next, purchase of stock in trade. Look at the trial balance. In trial balance, purchase of stock is there. How much? 2,10,000 is there. Return is 20,000. So it should be 1,90,000 is the purchase of stock in trade. This is how you have to bring the data from the trial balance to these two statements. Clear? Next one. Change in inventory. What is change in inventory? Change in inventory means opening stock of all except raw material minus closing stock of all except raw material. Raw material opening and closing is adjusted in the previous stage, this stage. Consumed. But in this question, there is no raw material. So there is opening stock of stock in trade is there. How much? Look at the trial balance. Opening stock of stock in trade. How much is there? Opening stock. 65,000 is there. Look at this opening stock of stock in trade 1/4/2022. 65,000. Closing stock. Look at this. So 65 minus 80 is equal to minus 15,000 is written here. Right? Understood? From the trial balance, we have to bring all these data accordingly. Next item is employee benefit expense. This is a format. For any question, this is the format. Only these numbers are going to change. Note number and these figures, value are going to change. The format remains the same. Okay, because that is given by Companies Act. You have to follow that only. Next one, employee benefit expense. How do you calculate it? All the expenditure related to employees. You can prepare a small note for that also. Employee benefit expenses. Employee benefit expenses. Yeah, employee benefit expenses. There is a salary. Okay, look, forget about this. There is a figure here. In trial balance, look at this. Trial balance. Salary is there? Yeah. 1,06,000. Forget about that. That's a small change I made. Whatever is there in the trial balance, you bring that into a statement, total, add it, and bring to P&L account. Clear? Salary, wage, bonus. Huh? What is that? Why rent? You are paying to rent to the employee. The heading is employee benefit expenses. All expenses relating to employee benefit should come under, yeah, insurance on employees, insurance for employees, everything related to employees should come under this category. Okay, clear. Next one. After that, what is there in the format? What is there? Finance cost. What is finance cost? Interest on bank loan, interest on debentures, interest on any other loan, bank charges. All put together should come under this finance cost. Not only paid, suppose you are having some amount in the trial balance, some amount in the adjustment. Look at this question. Interest, how much is there in the question? Interest. 14,000 is there. Okay. This 14 plus anything given in the adjustment. Any adjustment is there? Nothing is there. So we can leave it. Suppose if there is a sentence in the adjustment, interest on debenture is still payable 6,000. What to do? 14 plus 6, 20 will come under finance cost. Okay. Only that 6,000 is there. No, that 6,000 should be again written in the balance sheet under liability side in the name of current liability in the name of interest on debenture payable. Clear? Any data given after the trial balance should appear in two places. Say, for example, closing stock we just discussed. Where we written closing stock so far? To find out the change in inventories. We use that figure. Opening inventory minus closing inventory. We used it. Closing inventory was given outside the trial balance. Clear to you? One more place, the closing inventory given outside the trial balance should be written in balance sheet. Under asset side, in current assets, in the name of inventory. You remember we discussed the format, inventory. In that inventory column, you have to write the closing stock also. Suppose you have closing stock of raw material, closing stock of finished goods, closing stock of work in progress, and closing stock of stock in trade. All the things put together, total you have to take, you have to write it in the name of inventory. The totaling should be done in a separate working note and by giving a number for that. Look at this. These are all called numbers, working note numbers. Okay. How that amount has come in the statement. Clear to you? Next item in the profit and loss account. Depreciation. What is depreciation? Look at this figure given to you. Depreciate building by 2%, furniture by 5%. What is the value of building? How do you know? That is there in the trial balance. Building, where is building? Yeah, building is here. On this percentage. How much are percentage given? That percentage you have to calculate. Okay, and then furniture also. How much? 80,000 on this 5%. How much is given in the adjustment? That much percentage you have to calculate on the value of concerned asset given in the trial balance. And you have to add all those values of depreciation on all assets and you have to bring that to profit and loss statement in the name of depreciation and amortization. So what is amortization? If there is any reduction in the value of intangible asset, Look at this question. Goodwill is there. And the goodwill is reduced from 1 lakh to 90,000. The 10,000 will be called as amortization. That also to be added under the heading called depreciation and amortization. Okay. One more place. All these concerned depreciation should be reduced from concerned assets when you are writing the value in the balance sheet asset side. Suppose building 1 lakh is given in the trial balance. Depreciation 10%. In the balance sheet, building should be appearing in the value of 90,000 only. 1 lakh minus depreciation 10,000. So now building value is only 90,000. So like this, if you do, you can get the profit of the company as well as the financial position of the company. Just look at the rest of the things. Finance cost. Otherwise, anything is there, all those come under other expense. Any other expenditure. Now we have done A, B, C, D, E, F. E, F. G is nothing but any expenditure which is not written so far in any of the A to F. Say for example, sundry expense, commission on sales, advertisement, rent, everything should come under other expenses. Is it clear? You have to make a small table. In that you have to write all the items, rent, and then advertisement, commission, whatever is there, write everything, take a total, and the total should come here. Right? Now the total of all these things, total of all expenditure, total of all expenditure, A to G, whatever is there, add it, you will get one value that is called total expenditure. Already you have total revenue minus this total expenditure. From the total revenue, you will get profit before tax. If tax is there minus tax, you will get profit after tax. Is that clear? I just tell you in 2 sentences. Profit and loss statement is having a format. First, you should know the format. Format is given to you and it's just in front of you also now. You should remember the format, first thing. Second thing is, to prepare profit and loss account, we should have some trial balance. From trial balance, you have to pick only those items which are income or expenditure. Accordingly, in the format, you have to write it. If there is any expenditure or income given after the trial balance, that also need to be considered. Suppose dividend received in the trial balance is given 20,000. In the adjustment, dividend yet to be received 10,000. So in the other income column, in the profit and loss statement, you would write 30,000. Other income. Look at this, other income. Before this, other income is there, no? Other income. Dividend 20 received. Still receivable 10,000. It should be prepared like this. Okay, prepare one. I uploaded one Word document in your ERP. Okay, you can go through that. So many questions are there. You can just work out. For this particular chapter, please follow only what we are doing in the class. No need of referring any other material. Because in the textbook, it's a warning also. If you really want to pass, I think that is little subjective. Warning, cautioning, cautioning. Yeah, that's cautioning. Cautioning. Okay, right? It's not threatening. Okay. You should follow only this format. Because I see so many intelligence among you. Okay, I am such a teacher. I don't want intelligent student. I want only a student who is learning. After attending class, you can become intelligent. I'm happy. While attending itself, you are intelligent means I really don't want. Point is, follow this particular format. It's irritating when I correct your paper. Here the problem again is the driver, the conductor and the checker both are same. Conductor and ticket checker both are same here. That's a problem again. If conductor is different and checker is different, means no problem. Conductor will give a ticket, checker will give a fine if it is not given correctly. But here the problem is I am only giving a ticket, I am only checking it. That's irritating for me because you are not writing like BCom, so-called BCom and BBS are there. No, they will irritate me in the time of examination. They don't listen. Sir, P&L account I know. Balance sheet, yes, I know. But what do you know? The T format of balance sheet and T format of P&L account, you might have studied and you might be knowing at least 50% or 30%, no problem. Or good student, 100%, okay. I'm not denying it. But here Companies Act is saying you to do only like this. We are doing the balance sheet of a joint stock company, limited liability company. But when I'm correcting your paper, last 6 batches, I am correcting it, you will write again the T form, trading and profit and loss account. I never even used, except this time, the word trading account. But this guy will use trading and profit and loss account. But I get irritated. Just scratch it. I'll put 1 0. Because there is no provision for putting a minus mark. I can put only maximum. So please don't do that. I'm telling you, for the BCom and BBA, follow this format. Don't refer any other text for only this chapter. For any other chapter, you can refer any other textbook, no problem. Concepts are same. But only for this particular chapter, please follow this format. Okay, we have taken Tata Motors balance sheet as well as the P&L account last class. It was like this only. So please, for getting mark, follow this. And this is what really followed in the real world, not more than anything. Okay, what's the time now? Time for break. So balance sheet and the P&L account, you should be able to do it. For more questions, you refer that file given in your ERP and practice it. If you have any doubt, ask me in the next class. After the break, we can start with the financial statement analysis. Okay. See you after the break.
Sir, can you share this Word document?
Yes, madam. It's already shared. It is there in your ERP.
Okay.
I have taken one page of that. I'm showing you now.
Okay.
The entire is in the ERP. Discussion is analysis. Statement analysis. Financial statement analysis. Yeah, slide show. Thank you. So really, the accounting for manager means you should know something about deeper insight of the accounting data, and you have to be in a position to guide the management in taking some decisions, managerial decisions. In the previous session, somebody was telling, I was asking you, what is the objective of accounting? Somebody was telling to take decisions and all. Those things comes now only. Okay. Academically speaking, there are 3 branches of accounting I told you long back. Cost accounting, financial accounting, management accounting. So this concept comes under management accounting. So far, what you have done? Identification of financial transaction, entering into the books of accounts. That is nothing but preparation of journal and ledger. Then preparation of trial balance. Then we understood something on preparation of financial statement. All these put together, we call it as financial accounting. Financial accounting. Okay, that just gives us the results of the business. Results of the business. What is the asset? What is the liability? What is the equity? What is profit? What is loss? How much is the expenditure and how much is the income? This much only you can know from the financial statement of a business organization. Only statement. But I want to know whether I am doing better. Is there any problem in my company with respect to financial data? Am I earning enough profit? I'm earning profit. Is it enough? Suppose I ask a question. Still people are coming? Okay. Just think about this question I'm asking to you. There are two companies. A Limited is having a profit of 2 lakhs. Sir, listen. A Limited is having a profit of how much? How much? 2 lakhs. B Limited is having a profit of 3 lakhs. Which company is doing better? Huh? Let him. Why do you intervene his answer? Huh? He is drawing the attention. So I'm just asking a question. He is answering. Yes, sir, go ahead. Don't worry about this. Yes. Yeah. You go ahead. Tell your opinion. B Limited is having profit of 3 lakhs. A Limited is having a profit of 2 lakhs. That's a statement. Fact. That is known to you from profit and loss account. Right. I'm just telling you. It is there in the problem. If I'm not there, you can read from the A Limited balance sheet or A Limited P&L account. Right. Which company is doing better? We have only two companies, man. A Limited and B Limited. There is no company called 3 lakhs company. Which company is doing better? B Limited. It's not B company. B Limited is doing better. Why? Yeah, I said it is 3 lakhs. What is 3 lakhs? It's amount only, gentlemen. 3 lakh also amount only. 5 lakh also amount only. 2 lakh is not amount. Then yeah, more than 2 lakhs. What is 2 lakh and what is 3 lakhs? Is understanding bit by bit. Please listen. Yeah. What is 2 lakh and what is 3 lakhs? It is not P&L. 2 lakh is the profit of A Limited. 3 lakh is the profit of B Limited. Now, which company is doing better?
So your voice is not that clear, sir.
Okay, I'll just check it.
Yes, yes. Now it is fine, sir. Yes.
Okay. Yes, sir. Compare and tell us. Which company is doing better? That's it. Only one answer. Is doing better. Why? What makes you to make the statement that B Limited is doing better than A Limited? Do it. I did not give you. I give you only 2 figures. See, suppose you are going to an interview. Gentlemen, listen. Please, friends, listen. You are going to an interview. You are telling, sir, in my MBA, I got 72.4%. Your friend is also coming there. He is telling, sir, in my MBA, I got 69.4%. Interviewer is sitting this side. He will ask you the record of all your 120 classes. I want to review. Please give me. That's what you are asking, no? Sir, give me the statement. Statement, why? Once again, why are you preparing a statement? Know about the profit. I already told you the profit. A Limited profit is 2 lakhs. B Limited profit is 3 lakhs. Which company is doing better? Why? We agree with you. We receive your answer. We take in your statement. But we want to know the logic. What makes you to decide that? Yes, sir. So 3 is greater than 2 lakhs. That is why you are telling B Limited is doing better. Okay, let me ask the question in a different way. Your mark in mid-semester examination is 40. Your friend mid-semester mark is 80. Who is doing better? Okay, suppose his mark is 70. Still he is doing better. How, sir? We got 1 more person. Leave it. Yeah. Yes, sir. You are right. We are okay in receiving your statement, but we want the reasoning. 70. He has got only, yeah, mathematically 70 is greater than 40. This poor student has got only 40 according to you. But some more information revealing now. This boy got 40 mark out of 50. His friend got 70 mark out of 100. Then your answer stands good or your answer is going to change. Why? So it's other way around. He is doing better. Yeah, he is doing better. So with the help of 40 and 70, we are not able to take a decision. Or if you take a decision, that may not be a logical one. Will it applicable to your companies also? First company, A Limited got a profit of 2 lakhs. B company got a profit of 3 lakhs. Mathematically, you are right. Or 3 is greater than 2. 1 second. 2 is greater than, sorry, 2 is lesser than 3. You are right. But A company investment is just 1 lakh. B company's investment is 10 lakhs. Now, which company is doing better? You are changing your answer. Completely, you are reversing. So far, you told Congress. Now you are telling opposite. You are changing your opinion. Because we need some statement. Nation, international, national level. So we need complete data to decide about some companies' performance. The point is, absolute figure is trying to misguide you. Absolute figure is misguiding you. Absolute figure means 2 and 3, 40 and 70. It was misguiding us. So relative figures we want. What do you mean by relative figures? Out of what? Single figure if you take, it is misguiding sometime. If you give a relative figure, it will be guiding us properly. So percentage, you have to bring the number into a common platform, common term. Out of 100, how much is my mark? My mark is 80%. Out of 50, 40 is my mark. Out of 100, it is 80%. For my friend, it's already out of 100, he got 70. So 80% is being compared with 70%. It's very simple calculation. 80 is greater than 70. So I am doing better than my friend. That's all clear. So for this reason, we have to analyze the financial statement. We cannot simply say that A company is doing better, B company is doing better. Another example I'll tell you. A company has earned a profit of 1 lakh. B company has earned a profit of 2 lakhs. Okay, for a same investment of 10 lakhs. Investment is same. A company's investment is also 10 lakhs. B company investment is also 10 lakhs. But A company's profit is just 1 lakh. B company's profit is 2 lakhs. Which company is doing better? Okay, I'll give you one more data, then you should not change your answer. A company's investment was 10 lakhs and profit was 1 lakh in the year 2000. B company's investment was 10 lakhs and the profit was 2 lakhs in the year 2020. In the year 2020, which company is doing better now?
B.
Why I am telling this is, when you are comparing two timeline data, you cannot just take the data as it is. 1 lakh and 2 lakh. Of course, mathematically greater. 2 is greater than 1. You can simply say that B is doing better. But which year data it is? So one company's data is relating to one particular year. Another company's data is relating to some another year. That comparison is illogical. When you compare just 2 and 1, you have to convert these 2 into previous year's term or 1 into current year term. Time value of money comes into. Okay, so there are a lot of these kind of misguiding elements are there if you take as it is the figure. So we have to analyze the data to get a deeper understanding based on some logics. Okay, so this is important for getting deeper insights about the company's financial position as well as the company's financial performance. We know the performance, we know the position, but we are trying to understand whether this position is good or bad in compared to my own performance of last year or my own performance of another, I mean, my performance with another. Infosys is trying to compare its performance with Wipro or any other IT companies. Okay, a bank, HDFC Bank is trying to compare its performance with another bank. Okay, so that kind of comparison is possible only when if you analyze the financial statements. There are so many tools available for financial statement. If you want to analyze the financial statement, there are so many tools available. Are you able to get the introduction concept? The statement gives some data. The data, if you read as it is, it may sometime misguide us. So we want a deeper insight about the financial data in order to know some gray areas or in order to know some drawbacks of the company or to compare themselves with another company or compare themselves with themselves in the previous year. Clear? So for that reason, we are analyzing the financial statements. There are so many ways in which you can analyze the financial data. Tools for financial statement analysis. There are so many tools. Each and every tool is having its own purpose to achieve, purpose to serve. The basic tool is common size statement. Now only I told you. The profit, 1 lakh and 3 lakh. Simply if you take an example, it is misguiding. So common size, you bring the profit into 100%. Common size statement, comparative statement. Okay. Trend analysis, percentage analysis, fund flow analysis, cash flow analysis, and then ratio analysis. There are so many tools available for us. Most powerful tool is ratio analysis. I repeat again. Common size statement, comparative statement, trend analysis, fund flow analysis, cash flow analysis, and then ratio analysis. Okay, we are going to discuss only 2 tools in our syllabus. One is ratio analysis, another one is cash flow analysis. The cash flow analysis we can discuss in the next class. Now we try to understand what is ratio analysis and what are the different ratios are available. How do I compute it and how do you interpret it? It is not accounting. It's mathematics actually. What is ratio actually? Percentage is the only ratio. What is ratio? Comparison between 2 different numbers. Average age of the Dayanasar University EMBA students with the average height of the some other university students. Then what is that? 2 variables you told, no? Same parameter. 2 related variables. 2 related variables. Expenditure and income. We can compare. Expenditure, income. Spending and savings we can compare. In general, spending. Advertisement and sales we can compare. Advertisement increasing, sales is increasing or not, we can compare. Sales and profit we can compare. Investment and profit we can compare. How much I invested and how much I'm getting as return on investment. Okay, so there are so many comparisons. So comparisons are nothing but related variables. So ratios are nothing but mathematical relationship between 2 related variables. If that variables happened to be an accounting variable, that can be called as accounting ratio. Is it clear? Ratios are nothing but mathematical relationship between 2 related variables. Say for example, my income is 1 lakh. My domestic spending every month is 70,000 rupees. So my expense ratio is 70%. 70% of my total income of a particular month or a year is spending for my purpose, domestic purpose. 30% is savings. So this is a ratio. Okay. Ratios can be expressed in terms of number of times, percentages, or maybe sometime decimal. In the same example, 0.7 is my spending. Out of 1 rupee, I'm spending 70 paisa. Okay, or 0.3 I'm saving. So that's what ratio analysis, ratios. But in accounting, we have so many ratios. We have so many ratios. All those ratios can be classified into 4 categories. 4 categories. Ratios in accounting can be broadly with a meaning be classified into 4 categories. Based on decision making, based on analysis, we can classify them into 4 categories. First one is profit liquidity ratios, profitability ratios, activity ratios, and then last one is solvency ratios. Okay, liquidity, leverage is nothing but solvency ratio. Okay. Leverage, otherwise called as solvency ratios, activity ratios, profitability ratio. Liquidity, what is liquidity ratio? Liquidity, what is liquidity actually? Liquidity is nothing but an ability. You have to say correctly. Liquidity is nothing but an ability of what? Converting anything into cash with the 2 conditions. What is the 2 condition? Anything can be converted into cash without any loss in time, immediately, without much delay in time. Excellent. Any other point? One more condition. There's a building. You want to convert into cash, immediately you can do so. If you compromise one thing, you can do so. What is that? Suppose 1 lakh worth of land, you are giving it for 80,000. People will be in queue to buy it. Okay. That is called loss in value. So 2 conditions. Liquidity is nothing but an ability to convert an asset into cash without delay in time and without losing its value, market value. If these 2 things you want, you have to wait then. Sir, I want it for good price. You have to wait. Liquidity is less. Okay, good price. Sir, I want price, no problem. I can sell it immediately. Then you are compromising your price. So liquidity. So what is meant here for liquidity? This is the meaning of liquidity. Then what is meant by liquidity ratios? Look at this. These ratios are helping us to measure the company's ability to meet the current obligations. If your lender is coming and asking you the money on due date, it is you to pay. Your landlord is coming and asking you the rent, it is you to pay on the due date. On the due date, he is coming and asking you, are selling, sir, please come next week. I don't have money. If you are saying that, you are in the problem of you are illiquid. Your company is having illiquidity. Liquidity crunch is there. You are not having a liquidity in your company. So it's ability to pay off your short-term obligations, current payment, salary. Every first date of the month, you will pay salary. You are having good liquidity. Some companies, they will pay first 1 month. Next month, they will pay 7th. Another month, they may pay 10th. We may not be knowing the date of salary. That company is simply, don't have calculating liquidity ratio. You can simply say that that company is not properly maintaining liquidity. Vendor is coming and asking you the bill, money. You are telling, sir, next week. Then your liquidity position is in problem. So to know about the liquidity position of a company, we can measure through these ratios. There are some ratios, current ratios. We'll discuss about that. Okay. Now we understand what is meant by liquidity ratios. If you are going to give loan to a company for short-term purpose, you should be worrying about these ratios and you have to calculate and you can understand what is the liquidity position of this, whether I can give loan or not. Suppose you are a supplier, he is coming and asking you goods on credit basis. You should calculate these ratios, then you can come to know the liquidity position of the company, whether to give goods on credit or not. Okay. Second group of ratios are called as solvency ratios, otherwise called as leverage ratios. Solvency. Long-term liquidity is nothing but solvency. Short-term solvency is nothing but liquidity. Solvent. What is solvent? Chemical engineer, anybody is there? Solvent. What is solvent? That, yeah. So same logic here for a financial problem, for a financial nature. Okay. So long-term solvency is being checked here. You are going to a bank and approaching for a loan. Sir, 10 crore I want. I want this loan. If that is the case, the bank will be worrying about checking your long-term solvency by calculating certain ratios. Those group of ratios are called as leverage ratios or solvency ratios. Group of ratios. There are so many ratios. Simple concept. How much is your own money? How much is your borrowed money? Before the break, I was giving an example. 4 lakh I am borrowing, 1 lakh I am bringing in my own. So 5 lakh is total asset. In that case, 1:4 is the ratio of debt and equity. Debt is nothing but loan. Equity means our own fund. So 1:4, which is little risky. Take up Adani's case, Adani's group of companies. All the companies, there was an article also. All the companies are having this ratio very high. Not just high. Sugar level 90 or 100, 1000. Adani group is having that only. Alarming ratios, but still alive. Still alive. More than 120 is diabetics. More than 150, you have to take continuous insulin, something like that. But 1,000 living, coming and going, doing all the work properly. That means risky. At any time he may fall. But he is ready to take risk. Sir, after I feel anything, after I get into problem, ambulance will come, they will take care. That riskiness Adani Group is taking in terms of these ratios. Theoretically speaking, really there was an article, go and read it. Adani Group of companies, debt equity ratio. Normally we people are telling, you cannot borrow more than 5 times. But I'm borrowing. You should come to the classes every day so that you can get pass in the exam. But some student, they won't come to the class at all, but he'll pass. What to do? That's an exceptional case. He's taking risk. But he is achieving it. If he is taking risk and achieving it, we are appreciating. Yes, he is capable of doing it even without coming to class. He is able to pass. But there is a student continuously coming to all the 100% attendance. Exam relationship. So why I'm telling this is theory and practice. You should give an interpretation clearly. Suppose we are telling heartbeat should be 70 to 80 per minute for a normal human being. Suppose you are checking a patient, it is having some 250 or 200 or 170 or 150, something like that. Immediately you cannot put him into, okay, take him to ICU. You should ask him what is the problem, whether he has run and came to you, or he is coming in a lift, or he is having some other problem. Something you have to ask. So ratio is also like that only. Ratios are having some standards. Just like a human body, we have so many standards, no? Normals, abnormal. We have no right for all. Sugar level, everything we have. Similarly, we have also, suppose under this ratio, I'm telling debt equity ratio. Some ratios we have 1:4 or 1:5. Somebody is having more than that. We are alerting them, sir, you are having some problem, please take care of it. But it is left to him. But before you tell that, you should introspect what is this company is. Okay. What is the problem of this? Okay, 0% profit on company. It may be lockdown period. You simply cannot say, sir, investors will be facing a problem. You have to increase your profits. Sir, government told not to operate anything, but you are telling to earn profit. You have to earn profit. Company is under lockdown. You should know what condition it is in. Without knowing that, you cannot say 0% profitability. It's having very worst condition. This company should be closed or nobody should invest in this company. If you say that, that is illogical. So what I'm trying to say is ratio analysis are double-sided sword. You should use it very, very carefully. Simply by having a number, you cannot give a comment. Of course, that number is a guiding element for you to give a comment. But before you commenting, you should know detail about the company. Then only you have to comment. Okay. Are you able to understand now the logic? Third one is activity ratios. These ratios are trying to find out the efficiency of the company in utilizing the resources of the company. How effectively, how efficiently the company is earning profit out of 1 rupee of investment. I told you an example, no? Both the companies are having a same investment of 10 lakhs. One company is earning a profit of 1 lakh. Another company is earning a profit of 2 lakhs or 3 lakhs. Okay. Efficiency being measured in some group of ratios. Those ratios are called as activity ratios. Then last one, profitability ratios. Relating to sales. How much is my ability to earn profit? If I make this, how much is my profit? 10% or 20%, something like that. Okay, so these are all the group of 4 ratios. Okay, any doubt in this? Yeah. Sorry. So under liquidity ratios, we have. Oh, this is trouble. Are you able to see this? Liquidity ratio, there are 3 liquidity ratios. One is current ratio, quick ratio, and absolute liquidity ratio. Current ratio is nothing but the relationship between current assets and current liabilities. You by this time knowing what is current asset and what is current liabilities. Okay. 2:1 is the standard ratio. 2 times of asset can represent 1 times of liability. You are having a balance sheet. You are referring all the assets in the current asset category, and you are adding all those assets, dividing by the total of current liabilities. Okay. Current ratio is equal to current asset divided by current liability. Look at this. Current assets divided by current liability ratio. Why do we call the liquidity position of the company? If it is 2:1, 2 times asset is representing 1 time of current liability, means the good liquidity position. Generally, no sir, I have in my company 3 times of current asset of liabilities are there. What does it mean? That is okay, mathematics. That is the problem. You should not. Better. It is required for you heartbeat. Sir, 100 is there, still better. Can we say like that? Required is 70. Problem is there. Exactly. Not utilizing the asset. 9 o'clock. When you should come? She is coming by 6:45. Cannot say good only, sir. For what? Sir, there is an exam. That day he came by 6:45. Good. But in general, 6:45 is coming, means there may be a problem. Okay, there may be a problem. Okay, like that. So I hope you understand the logic what I'm trying to say. So 2:1 is the standard. But if you're having 3:1, meaning is not utilizing the current assets properly. Unnecessarily, you are locking up your money into current asset, which will be hampering your profitability. Liquidity and profitability both are in 2 different directions. Another case, other way around. 2:1 is required, standard. But your company is having 1:2, meaning 1 time of current asset, 2 time of current liability. What is the issue now? What's the interpretation you can say? Yeah, liabilities are more. You are under risk, not loss. You are under risk. If you're able to manage all your suppliers, all your employees, some companies' employees will be there. Sir, give me 5,000 rupees every month. No problem. Once in a year, you give me all my salary. I will buy 1 plot. That's all over. There are some people. For them, it is okay. If those kind of employees are there in your company, 3:1 also okay. 3 times of liability and only 1 time of asset you can manage. Profitability will go up, but that is risky. Liquidity crunch will be there. You are cutting a sorry figure in front of your financial obligations. You may say sorry to your landlord, sir, next time I will give you the rent together. That is really unwanted. Your credit worthiness is getting affected. Okay, so that is another side of it. Okay, but it is not always common for all the companies. Just now I told no. You should apply this logic. This is general logic, but this logic should be applied only after looking into the company's reality, what company it is. Okay, next. Quick ratio is nothing but quick assets divided by current liabilities. Quick assets divided by current liabilities. What is quick asset? Quick asset is nothing but current assets excluding inventory. Current asset excluding inventory is called as quick assets. Current assets excluding inventory divided by current liability is called as quick ratio. Okay, quick ratio. Next, absolute liquid ratio. Absolute liquid ratio. Look at this. I think you are able to understand the logic. First one, little generic measurement. Second one is little stringent measurement. Third one is more tight measurement. Look at this numerator. Only very much cash. It's just a cash. Cash in hand, cash at the bank, and short-term securities are taken into consideration. Inventory is excluded. Debtors are excluded. Prepaid expenses are excluded. Accrued incomes are excluded. All those current assets are excluded. It's a real money with compared with current liability. So it's the most stringent measurement of liquidity of a company. Okay. If you are really particular about the liquidity position, you have to see this ratio. In this ratio, at least they're having 1:1 or sometimes 0.5:1. Okay. 0.5:1 also. So this is called absolute liquid ratio. How do you calculate all these ratios? With the help of balance sheet or with the help of financial statements. Any ratio, if you calculate both the numerator and denominator, you take from only one statement. That ratio can be named after that statement. Suppose this statement, this ratio you're calculating by taking all the items only from balance sheet, right? This ratio can be otherwise called as balance sheet ratios. Any ratios which use the variable only from balance sheet can be called as balance sheet ratios. Okay. Any ratio which is using only income statement data, that can be called as profit and loss account ratios. Any ratio which is taking one variable from one statement, another variable from another statement can be called as combined ratios. But this classification does not have any much significance. So we don't worry about that classification. Okay. Next one. Long-term solvency ratios. Long-term solvency ratios, otherwise called as leverage ratios. Leverage ratios. Long-term solvency ratios, otherwise called as leverage ratios. First one is debt equity ratio. Very, very important long-term solvency ratio is debt equity. Who will be worrying about debt equity ratio? The banks who is going to give loan for companies for a longer period of time, or anybody who is going to buy the debentures of the company should worry about this long-term solvency ratio. That is particularly debt equity ratio. Whether this company will be able to pay off my debt after that due date. That is being measured in debt equity ratio. Okay. So how do you calculate? Debt to equity ratio, how do you calculate? Only you have to compare these two terms, right? Debt to equity. Debt and equity is being compared. Shareholder fund. Yeah. Debt to equity ratio. Debt by shareholders fund. What is debt here? Debt is nothing but loan. What words will be there in balance sheet? Debentures, long-term loan, term loan, simply loan, loan from financial institutions. Any loan which is having a longer period of time for maturity. Okay, it's called debt, long-term debt, divided by shareholders equity, where you can take this shareholder equity from balance sheet under liability and equity column. The first item itself is shareholder fund. Shareholder fund, we had an item now in the balance sheet. The total of that you will take A and B. What is A? Equity capital. B is resource and surplus. Put together is called shareholders equity. Shareholders equity. Similarly, after that, in non-current liability side, you can find out debt. Okay. If you are having one time of debt and 2 time of equity, what is the interpretation we can say? 1 lakh is debt amount, 2 lakh is owner's money, equity capital. So what is the interpretation you can say? That is mathematics. Come to the logic. Huh? Company is doing well. Is it a profitable ratio? Then why are you talking about well or not well? Yeah. As a creditor, as a loan giver, I should be happy. If this company comes to me to ask for a loan, I may, without any kind of hesitation, I can lend money, because 1 time of debt is there, 2 time of ownership is there. I can give 1 more lakh as loan. Suppose 2:2, 1:1. 1 lakh loan, 1 lakh equity. That company comes to you. Then what to do? You can still give loan. No, you can still give loan. Equal is there. Still you can give loan. 2:1. 2 time of loan is already there. 1 time of equity is there. That company comes to you. That time is little risky. 3:1, more risky. Okay, but now I'm telling like this. Next semester, Okay, next trimester in your corporate finance, your teacher will tell you, borrowing more and more is good actually. Two, yeah, trading on equity. Do business with others' money. If anything goes wrong, say buy and go. All right. More efficiency. See, it's a small difference, that's all. Doing business with others' money will give more value to the shareholder. You should not think about me in the next semester when teacher is telling, do more, business with borrowed capital. I'm telling that also now. That is good. That will give you more value to the shareholder. Because borrowed money is having an obligation of only limited amount of payment of interest. You are borrowing 100 rupees, earning 30 rupees profit, giving only 6 rupees as interest. Remaining 24 rupees is going to whom? Shareholder to divide. In that way, levered company, look at that word. Levered company means a company which is using borrowed capital. A company which is using a borrowed capital in finance is called as levered company. Levered buyout means what? You are buying a company by borrowing money. Tata was purchasing Chorus company by borrowing loan from SBI. It's called levered buyout, levered purchase. Okay, so doing business by borrowing is good, not bad, but you are borrowing money at the rate of 6% interest, but you are earning profit only 5%. That time, the remaining 1%, where should you give from? From the capital you have to take. Owner's money is there, no? From there you have to take and you have to pay interest alone. That kills the capital, that erodes the capital, that reduces the capital. That's not good for the company. Two sides you have to look into. This you will discuss in the financial management later. Come to this. Next ratio is debt to capital ratio. So total debt divided by total capital. Total debt. It is nothing but, in our example, 1/3. In my example, 1 rupee is borrowed capital and 2 rupees owned capital. So total capital is 3 rupees. So 1/3. The denominator is total capital. The numerator is only borrowed capital. Borrowed capital divided by total capital is equal to debt to capital ratio. Debt to capital ratio. So how it can be? 1/3. Another one is 2/3. Another one is 3/3. 3/3 possible? 3/3 is possible? Why it is not possible? Owner is not having any money, borrowing all the money from outside. That's not possible. At least you should have 1% or something. Okay. So which is good for the company? From the traditional point of view, from the solvency point of view, debt capital should be as minimum as possible. These total should be strong. Okay. Next, proprietary ratio, another important ratio to find out the solvency of a company or leverage of a company is proprietary ratio, that is being computed by dividing the total shareholders fund divided by total asset. Total assets, tangible assets, total assets. Can you make any sense out of this? The numerator is owner's money in the business. Equity capital. What money introduced by the owner? What is earned by the owner so far, not taken back from the business? That's called total equity. Shareholders fund. Equity shareholders fund. Divided by total assets. I invested 1 lakh in my company, but my assets are 10 lakh. Possible? Possible or not? Say yes, possible. Meaning you borrowed 9 lakh rupees. Okay, in that time, what will be the equation now? 1/10. 1/10. Another company, they have 10 lakh as equity and 10 lakh as their total asset. What's the answer? 10/10. 1:1. 10/10. Which company is doing better? Not better. Which company is looking more levered company? First company is more levered, more risky. Levered means risky. What is risky there? 1 time of equity. By having 1 rupee, they are making a business of 10 lakh worth of assets. Asset base is 10 lakh, but contribution by the owner is only 1 lakh. If there is any sudden shock in the market, COVID, lockdown, or customer preference changing, or when technology changing, that time this company will have a bad hit. Okay. Other company which is having 10 by 10, not have any effect at all, any impact. Okay. So in that way, you have to understand this ratio called proprietary ratio. Suppose you are a loan giver for this company. Loan giver for these two companies, they are coming to you for loan appraisal. Which company will prefer? 10 by 10. 1:1 company will prefer. They don't even have any loan, so they are giving loan. Another company is having already 9 times of loan. 9 times of their owned money is from loan capital. They're very, very risky. So we should not go for a company which is already having a lot of loan. But that company, if it's doing very good, as a shareholder, I can go to that company. As an investor of equity share, I can prefer a company which is having more leverage, provided they're having a stable sales. There is no ups and downs in sales. Okay. Next. Debt to asset ratio, total debt divided by total assets. Is it any problem in this? You have to remember all these equations based on the name of the equation. Now you see debt, asset to debt ratio. Simple. Asset by debt by asset. In that logic, you have to understand. What is the interpretation here? Debt is 1 time and asset is 10 times means what does it mean? Debt is 1. 1 lakh is debt and 10 lakh is asset. What does it mean? What is the interpretation you can make? Borrowing still more. Huh? More. So the company is not leveraging out. The company is not taking any risk. See, the ship is made only for sailing in the water, going into the sea. If sir, I want to be very safe. You are building a ship, the hull is built, and the hull is always kept in the port itself. What is the use? No use. You should take a risk. Business means taking risk. So that kind of interpretation you could make. But what kind of risk? Sir, the tsunami is there. That time you are sailing in the water. That time, sir, I want to take risk. Yes. Next. Interest coverage ratio. Interest coverage ratio means how much you are earning as profit before interest and tax to cover your interest payment. Suppose you borrowed money, you have to pay interest. Means you are not paying the principal back, no problem, but you have to pay interest. That time, how much you are earning profit to make out your interest paid. My total interest payable is 1 lakh every year. At least I have to make a profit of 1 lakh rupees so that I am not taking any money from my shareholder to pay interest. Okay. So higher the interest coverage ratio, better the solvency of the company. Look at this earnings before interest and tax. EBIT, earnings before interest and tax, profit before interest and tax divided by interest. What is interest? Fixed income charges. What is your total borrowing? What's the percentage of interest? Calculate that. Okay. Suppose 1 lakh is your EBIT and interest payable for the period is also 1 lakh. It's okay. Not bad. You are capable of managing at least your interest, not giving anything to shareholder. If you are not giving anything to shareholder, also okay, but you should not take their money from the capital to pay the interest. Otherwise, suppose 2 by 1, good. 3 by 1, still good. 10 by 1, better. So higher the interest coverage ratio, better the solvency of the company.
So what is EBIT?
Earnings before interest and tax. Earnings before interest and tax. Nothing but profit before interest and tax. In our profit and loss account, we saw, no? Except that finance cost, whatever your expenditure minus from the total income, that is called EBIT. Yeah. Next group of ratios. Next group of ratios are activity ratios. Activity ratios, otherwise called as turnover ratios. Turnover. Activity, otherwise called as turnover. What is turnover? Sales. We are comparing each and every accounting element possible with sales, with turnover. What is my asset? What is my turnover? What is my working capital? What is my turnover? What is my debtor amount? What is my turnover? Like that, we're comparing. Okay. The first one is inventory turnover ratio. Inventory turnover ratio is trying to compare the average inventory with the net sales. Okay. Let us look at the equation. Net credit sales divided by average inventory. Net credit sales divided by, sorry, I think double clicked. Equation is not there. Okay, write down the equation. Inventory turnover ratio is equal to net credit, sorry, inventory turnover ratio, no, cost of goods sold or sales divided by cost of goods sold. Otherwise, sales. If you have cost of goods sold, you can take. Sir, in exam and the paper and the question, COGS is not there. Only sales is there. You can take sales. Correct measurement is COGS. Cost of goods sold divided by average inventory. Average inventory. What is cost of goods sold? Sales minus gross profit. Otherwise, cost of goods sold is equal to opening stock plus purchases minus closing stock plus any operating expenses. Okay. That's called cost of goods sold. Simple literary meaning. Cost, how much you are spending to make your goods to be sold. Cost of goods sold. Cost of sales. Okay, simple. Sir, I sold it for 10 rupee. My profit is 2 rupee. That is the case. What is the cost? 8 rupee. Okay. Now, what is the interpretation for this ratio? Interpretation. You will get some number, right? By applying this equation. Average inventory is nothing but opening inventory plus closing inventory by 2. Opening inventory plus closing inventory by 2. Where you will find opening inventory? Trial balance or last year balance sheet. Where you will find the closing inventory? Current year balance sheet. Add it together by 2 is equal to average inventory. Suppose there is a company whose average inventory is 1 lakh and whose cost of goods sold is 10 lakh. 10 lakh by 1 lakh. What's the answer? 10 by 1, 10 is to 1. Another company is having a same amount of sales, 10 lakhs, and average inventory as 2 lakhs. What is the answer for them? 10 by 2 is equal to 5 is to 1. Which company is good? Why, sir? They are selling more. Both the companies selling same amount of 10 lakh, 10 lakh. They are able to convert the inventory into sales quickly. This company is going to convert the inventory little late. Next equation. Average collection. Sorry. Next one. Debtors turnover ratio. Debtors turnover, otherwise trade receivables turnover ratio. Trade receivables turnover ratio. Debtors turnover ratio. Debtors turnover ratio. It is nothing but the relationship between credit sales and the debtors. How much I am selling as credit on credit and how quickly I am getting back my money from the customer. That is being measured in this kind of ratio. Write down this equation. Net credit sales divided by average accounts receivable. What is net credit sales? Total credit sales minus sales return. Total credit sales minus sales return is called as net credit sales. What is average accounts receivable? Opening stock of debtors, opening stock of bills receivable plus closing stock of debtors plus closing stock of bills receivable divided by 2. Or simply opening stock of accounts receivable plus closing stock of accounts receivable by 2. Where you can find these two? One is from the current balance sheet, another one is from previous year balance sheet. Now, which is good? How do you interpret the answer? Suppose credit sale is 1 lakh. Accounts receivable is 10,000. Listen carefully. Finding out the answer is not that great. Calculator will do. But it is you to give the interpretation logically. Now, credit sales is 10 lakh. Sorry, 1 lakh. Why? 10,000 is accounts receivable. Answer is 10:1. 10:1. Another company is having same amount of credit sales 1 lakh and their accounts receivable is only 5,000. What's the answer for them? 1 lakh by 5,000 is equal to 20:1. Now which company is doing? Which company is good? Huh? Second company. Why? Fast. They're receiving faster than the previous company, another company. Okay, so higher the ratio, better the efficiency of the company, better the performance of the company. Higher the ratio. Next one, average collection period. Average collection period. Next one is average collection period. No, just average collection period. What is average collection period? How many days or how many months you are waiting to receive back your money from your customer to whom you sold goods on credit basis? I repeat again. Average collection period is nothing but the period within which you are getting back your money from your customer to whom you sold on credit basis. How do you calculate? Already we know the accounts receivable turnover. Okay, I mean trade receivable turnover ratio I know. Okay, based on that I can just calculate, write down the equation. Number of days or a month in a year. Number of days or month in a year divided by trade receivable turnover ratio. Trade receivable turnover ratio. Trade receivable turnover ratio. You already know what is trade receivable turnover ratio. You calculated. Say for example, 10 is your answer. 10. Trade receivable ratio is 10:1. So 10 is the answer. 10. Total number of months in a year is 12. 12 by 10 is equal to 1.2. Meaning is within 1.2 months, you are getting back your money from the customer. Another company was having 5, you know. Another example I told you 5. 5:1 or 20? Yeah, 5:1. 20:1 or 5:1? 20:1 I told you. 20:1. So 20. Now 20 is the answer. Now 12 by 20 is equal to 0.6. Meaning half month. No, half little more. Half month and little more. 0.6. 15 days plus some days. 0.6 is more than half month. Okay. So meaning is it's collecting within 0.6 months the debt from the customers. Okay. So that company is better. Okay. So higher the turnover ratio, higher the receivable turnover, better the company. Lesser the average collection period, better the efficiency of the company. Clear to you? Lesser the average collection period, better the efficiency. Meaning that company is having a good collection department and having a good collection policy, and their customer also honest and paying. There are so many interpretations you can give. Next one is trade payable turnover ratio. Trade payable turnover ratio. Trade payable turnover ratio. Just opposite. How much you are paying your money to your supplier. Okay. This who will calculate? Your supplier will calculate before they give goods on credit basis to you. Look at this equation. Credit purchase. Forget about this. Net credit purchase divided by average accounts payable. Net credit purchase divided by average accounts payable. Net credit purchase. Net credit. What is net credit purchase? Total credit purchase minus purchase return. You should not take the total purchase, only credit purchase. Yeah. So what is the interpretation? Lesser the payable turnover ratio, better the collection of our supplier. Our supplier is able to collect from us. Okay, but for us, higher. See, actually, in financial, it's kind of two side for everything is there. One is from your own point of view, another one is from outsider point of view. The opposite party, the other party, stakeholder point of view. those days in financial management, people will say like this: delay the payment, urge the receipt. When we were studying 20 years ago, financial management theory, delay the payment and urge the receipt. Urge means what? Make it very fast. Urge, U-R-G-E, urge. Urge means you have to make 100 calls every day to your customer. Ask for the, don't leave the call from supplier. If you do that for 2 weeks or 2 months or 2 years, then you have to close your business and go. Correct. Nobody will come and buy from you and nobody will be selling to you. But that is having a sense. That's little understandable. What is that? You have to, as much as possible, you have to delay. You should not leave the call unattended. You have to attend the call and you have to ask about his family, everything. And lastly, you have to say, sir, okay, next week there will be a payment. But for the customer, what should you say? Immediately after dying, sir, when are I depositing the money? That is called urgent receipt. Delay the payment. That's financial management olden days concept. But today it is not so. Today, if you do like that, then your credit worthiness is affected. Again, depends upon the parties. Some supplier will be there. You are the only customer for them. For those people, you can pay once in a year. Every Diwali, you can pay a payment. They're okay because you are the only industry also. There are so many suppliers available. They don't want to leave you. So many suppliers for you available. For him, it is you are the only customer. Again, depends on the situation. That's why doing a business is not that easy. It's not. There is no universal principle. I'm telling, delay the payment as the receipt. It cannot be applicable for some situation. It may be applicable for some situation. But in general, that holds good. Okay. So this ratio is measuring the number of, the time period that is required for paying your liabilities. One more you can take average payment period. Average payment period. Connected to this average payment period. What's the equation? Number of days or number of months in a year divided by?
Sir, average payment?
Average payment period. Meaning how many days you are normally taking to settle your suppliers. It's equal to number of days or number of months in a year. If you want to take in a number of months, 12 by. If you want to take a number of days, means 365 by. Okay. Divided by trade payable turnover ratio. Trade payable turnover ratio, which already we know. Yes, more is better without affecting your supplier's relationship. Okay. Yeah, equation is number of days or number of months in a year divided by trade payable turnover ratio. Interpretation is more the number what you are getting is showing that your supplier is very generous enough in allowing you to keep the money with you. 1 second, yes, sir. Not compulsory. Not compulsory. No, not only this formula, anything for that matter, there's no compulsory. Remember all the things. It's left to you. It's already there. Model question paper. That's also there in the ERP, right? No, Ravi sir has shared all the question paper of all the subject in one folder. You can refer that. If you want to calculate, you should remember. Yes. But question is not that. Sir is asking, should we remember all these formula? Answer is yes. No. Doing EMBA is compulsory? Yeah, then you have to remember. Okay. See, actually, sir, it's very simple. See, ratios are there. I understand your question logically. Simply, like I said, I'm telling. So many ratios are there. That's why he's worrying, sir. Should we remember all these equations? It's simple logic is you look at the equation. Logic you understand, then you can easily remember. It's not remembrance. You can derive the equation from the name of the ratios. Debt to equity. Why do you worry about other things? Only debt and equity. But what is to be numerator and what is to be denominator, you should know that much. We'll close it. Huh? We'll close it by completing this. Yeah, net asset, working capital to working capital turnover ratio. Don't write the heading. Working capital turnover ratio, write it. Working capital turnover ratio. Working capital turnover ratio. Relationship between working capital and sales. Turnover means sales. That's all. So equation is net sales divided by working capital. What is working capital? Current assets total minus current liabilities total. Net sales. This is total sales actually. Credit and cash both put together. Net sales divided by working capital. Working capital is nothing but total of current assets minus total of current liabilities. Okay. Next major heading, profitability ratios. Just 5 minutes, we'll finish it and go. Actually, we are more lacking with time. Okay. Working capital turnover ratio. What is working capital? Working capital is nothing but the total of current asset value minus total of current liabilities value. Okay, next one, profitability ratios. Just these 4 ratios we can take. Gross profit ratio, first one. It is represented in terms of percentages. Profitability ratios are represented in terms of percentages. First one is gross profit ratio. The equation is gross profit divided by net sales multiplied by 100. I'll check the equations are there. I'll show you. Otherwise, I'll tell you, you can write it. Yeah, it's there. It's there. Gross profit divided by net sales multiplied by 100. Yeah, net sales means what? Total sales minus sales return. Total sales minus credit does not come here. Total sales minus sales return. Higher the ratio, better the profitability. For this, higher the ratio, better the profitability. Next one, net profit ratio. Okay, nobody asked me, sir, what is gross profit? Sales minus cost of goods sold is gross profit. But in our format, there is no word called, you remember no format. In that, there is no capturing of gross profit. Previously, it was there. Now, Companies Act is not telling to show the gross profit to the public. Gross profit is nothing but total sales, sorry, net sales minus cost of goods sold. What is cost of goods sold? The direct expenses, opening stock plus purchase plus direct expenses is equal to total cost. The total cost is minus from sales. That is called gross profit. From gross profit, you minus all indirect expenses, rent, interest, salaries, all these things. But don't worry about all those details. We will be giving you the cost of goods sold and the sales. You can just compare this, you can find out gross profit.
Aditya.
Gross profit by net sales into 100 is equal to gross profit ratio. Next one, net profit ratio. Net profit ratio. Net profit divided by net sales into 100. Net profit, you can directly get it from the profit and loss account. The last net profit means profit after tax. Divided by net sales. Net sales, you can find it from profit and loss account, first point. Operating revenue. Yeah, all these profitability ratios. Profit is compared with sales. Multiply by 100. So the interpretation is greater the ratio, better the efficiency, or better the profitability. Next one, operating ratio. Operating profit ratio you take first. Operating profit ratio you take first. Operating profit ratio. Net profit ratio gives a overall profitability of the company. Suppose a company is having 40% profitability, 40% net profit ratio. We can say as good company. But if you go a little more inside, see, somebody is living in a very big house, bungalow. Okay, very good house. We may think that, okay, he's a rich person. Yes, but after going inside, he will say, sir, this is a rented building. That time also we are happy. Okay, this much big house is able to pay rent. Then he will say, my rent is paid by my friend. Yesterday, somebody is telling in Chennai, he's telling, he's living in a big bungalow and he's telling that my friend who studied along with me in IIM Lucknow is paying my rent. Okay, good. That time also you're happy. Meaning he's having that kind of friends to help him and that kind of capable person to help him. Then later he's telling every month same person is not paying, every month different person is paying. So this is like that kind. Gross profit, I mean, he's telling first one, okay, big picture. Okay, we are telling, oh, this company is good company. Next, we are going inside. The net profit is little less. That's also okay. After that, we are seeing what is your operating profit. You are having 40% profit of 100 rupees sales. Then this will be continuing for every year. No, sir. In this particular year, I sold one piece of land near Banarkata Road. That gave me 2 crore profit. Next year, will be having any other to sell? No, sir. Then that 40% is not going to be continued. So net profit ratio will also misguide you. You have to go for which ratio? Operating profit ratio. Sir, what is your business? Manufacturing cement. In manufacturing of cement, how much you earn to profit? Only 10%. That you tell me. Then I will take a decision to invest in a company or not. So that is what? Operating profit ratio. Write the equation operating profit by net sales into 100. Then what is operating profit? Operating profit is equal to net profit plus non-operating expenditure minus non-operating income. Yeah. Net profit is equal, sorry. Operating profit is equal to net profit plus non-operating expenditure plus non-operating, don't confuse me. Plus minus, you don't tell me, I will tell you. Net profit minus non-operating income plus non-operating expenditure. Simple logic is, I'll tell you, then you write the equation on your own. Simple logic is, you earned net profit of 50,000. Before earning that 50,000, you had one profit of selling one land, 10,000 rupees is already included. Then what is your operating profit now? 50,000 rupees is the profit reported in the P&L account. Reported in P&L account. But there is one other income in the P&L account, second line, 10,000 as profit on sale of land, 10,000 is there. Then what is your real operating profit? 40,000. Why? The 10,000 is not an operating profit. The 10,000 is other income. By selling a land, you gain 10,000 rupees. That need to be minus. So you write it minus net profit minus non-operating income plus non-operating expenditure. Suppose you minus one expenditure before arriving at 50,000 rupees. Loss on sale of furniture, 5,000 rupees. You already written in the other expenditure. You remember in the P&L account, other expense, last column, 5,000 rupees you wrote. After minusing 5,000, only the profit is 50. That is not an operating expenditure or operating loss. It's a loss because of selling one furniture. You won't sell the furniture every year, and that also not your job. Your job is manufacturing cement, in my example. So that 5,000 need to be added back to find out the real operating. So operating profit is equal to net profit plus non-operating expenditure minus non-operating income. Higher the operating profit ratio, better the profitability of the company. Next one. Now it's 4:30. Yeah, I told you already 5 minutes I'll take extra, right? 4:30 only you have to complete, right? Okay, I'm saying now. Operating ratio. Next one is operating ratio. Operating, because if you stop, yeah. Yes. Each and every word is having a meaning. Yeah. Companies Act. This is not from Companies Act. This is, yeah, this, you can only evolve ratios. Companies Act does not tell you all these things. And there are some I mean, difference of opinion between authors also. We'll talk about later. First, we'll understand what is there already. Yeah, this one, concerned expense, don't write this. Operating ratio is equal to concerned expenditure divided by net sales into 100. Operating ratio. Okay. Operating ratio. I'm sorry. Write it like this. Operating expense by net sales. I'm sorry. Operating expense by net sales into 100. Operating expense divided by net sales into 100. Operating ratio. It's about expense actually. How much is your operating expense in your company for 1 year? So 2 lakhs is my operating expenses. Out of spending 2 lakh rupees in terms of operating expenses, how much sales you made? That's what I'm measuring here. Okay. Now, what is the interpretation here? Lesser the operating ratio, better the profitability of the company. Okay. Next one. Expense ratios. Expense ratio. Expense ratio. Expense ratio. What we are doing is individual expenditure you can take and compare with sales. Individual expenditure. So we don't want to write each and every individual expenditure. We can write only one point. Concerned expenditure divided by net sales into 100. Suppose you want to calculate administrative expense ratio, you will take administrative expense by net sales. Concerned expenditure. Yeah, no, it's not you are concerned about. No. Here concerned means not that meaning of concerned or affect. Okay, related expenditure. Specific expenditure. That meaning I'm telling. Specific. Suppose you want to calculate about administrative expenditure with sales. So you take admin expense divided by net sales into 100. Okay.
Sir, expense ratio is equal to?
Yeah, you'll come that later. Time. Yeah. So correct.
So
Right.
expense ratio is equal
Expense ratio is equal to concerned expenditure by net sales into 100. What I mean by concerned expenditure means any specific expenditure for that matter. You can calculate as many ratios as possible based on number of expenditure. Admin expenditure, raw material, advertisement, selling expenditure, commission, rent, any expenditure for that matter you can compare with sales into 100. What's the interpretation? Lesser the expense ratio, better the profitability of the company. Next, last but one. I think so. Yeah, ROI. ROI is very, very important ratios, right? Return on investment. Return off investment. Return on investment. What's the equation? Return by investment. What is return? What is return? It's not about how fast. Yeah. If I invest 1 rupee in the company, how much I'm getting back? Okay. Sorry? No. It's not spending, no? You are confusing with spending and investment. Spending is different. Don't confuse both together. Spending is nothing but something what you're spending today. Investment means how much you invested in total into your business. Suppose I started a business by investing 1 lakh rupee. But my business is spending this current year only 20,000. That is different. But how much I invested? 1 lakh. After 1 year waiting, how much I'm getting back as return, profit from this company? Maybe 20,000, maybe 10,000, whatever it is. So that relationship. Return here refers to the profit. Write it. Return on investment is equal to profit to shareholders. Profit to shareholders divided by capital employed. Divided by capital employed, or you can call it as investment. Capital employed. This can be otherwise called as ROCE. Return on capital employed. Both are same. Return on capital employed or ROI. Both are same here. Yeah. Profit to shareholder divided by investment or capital employed. Yes, sir. What's wrong? That is called payback period. Yeah. See, what is this? Next semester you'll study in corporate finance. Suppose you're investing in a project 10 crore. Within how many years you're getting back the 10 crore is called as payback period. That's not ROI. Okay, that's different. Okay. Return on investment. What is the interpretation? ROI is nothing but in percentage only. Return by investment into 100. What's the interpretation? Higher the ROI, profitability. It comes under which ratio? So you use that. Better the, I mean, higher the ratio, better the profitability of the company. Write down this also. This is your second assignment actually. Yeah. Assignment number 2. That's why I did not upload. Today I'm finishing, I'll upload tomorrow. So be careful. Huh? Last date.
Sir, is it a group assignment or individual?
Individual.
Okay, sir. Thank you.
Sir, can we
Okay, you
have
can do
as
it
a
in group.
assignment, sir?
Submit it
Please, sir.
individually. Submit it. No, just telling. If you want to do it in group, do it in group. 2 assignment together. Group of 2 members. Submit it individually.
We'll do it as a group assignment.
It is.
So 2 members,
Individual
we are
assignment.
10 members in a group.
Madam, so sorry. I'm just telling you for lighter sense. It is an individual assignment.
Okay,
I'll
sir.
explain
Thank
about that in my description in the assignment or in the next class. Okay. We'll
Okay.
complete this. Financial statement analysis of 2 companies. Okay. I'll talk about that little later. Okay. Earning per share, EPS. Very, 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 very important ratio for investor. Suppose you want to invest in equity market, you have to see this particular ratio. Okay. One small example. Now we have seen in so many results, so many figures are there if you work out all these ratios. First monthly test 40%, second monthly test 50%, mid semester I got 60%. Like that, so many percentage I have. Finally, what is your mark? That is easy to take an average in mark, but here so many things we measured. I want to know whether this company is good or not. I want to invest. The purpose should be decided before you select the ratio to rely upon to decide whether it is good or not. The purpose. Now the purpose is investing in equity shares of the company. That time EPS you can check. EPS is nothing but profit available to equity shareholders. Profit, or you can write like this also. Both are same. Profit available to equity shareholders divided by number of equity shares. Don't worry about this. Write just number of equity shares. Profit available to equity shareholders divided by number of equity shares outstanding. Number of equity shares outstanding. Simple example I'll tell you. You start with the sales, right? The starting point is sales. The bottom line is profit. Okay. After finding out the profit, net profit after tax, you have to pay some amount as dividend to your preference shareholders. If anybody is there in that category in your company. 2 types of shares are there. One is equity share, preference share. Just nothing but they are given money, but they are called as preference shareholders. By right itself, they are having a priority in getting dividend from the company first before the equity shareholders. They are called as preference shareholders. Normally, there won't be there in company. Some company will have. If it is there, very negligible. But if it is there, how much amount you have to pay to them as dividend, you have to minus from net profit after tax. That is equal to profit available to equity shareholders. Equity shareholders. Divided by number of equity shares. Where you will find number of equity shares in the company? In the balance sheet, note number 1. If you go note number 1, the total capital, how it is divided by. In the example also I told, trial balance I told you. 20,000 shares and 1 lakh equity shares. Something I was there. No? Yeah. And 1 lakh shares of 10 each. So 1 lakh 2,000 shares are there. In that case, you cannot just divide this. You have to take a weighted average. For that reason only it is written weighted average, but don't worry. Assume the company's equity shares are common in denomination. 10 rupee shares are there means you can take the number of share and you can divide. So what is the interpretation? Interpretation. Huh? Higher is better. EPS, earning per share. If I wait for 1 year in this company after investing my share amount in 1 equity share, how much I'm eligible to get? It is not what I'm getting. EPS is what I am eligible to get, but company is giving or not? That is left to the company's dividend policy. 5 rupees is EPS. Company may give 5 rupees as dividend. That means 100% they are giving as dividend. Some company, what they will do, they retain 50%. They give only 50% as dividend. They want to reinvest in the business itself. Okay. So this much is fine. Next class, we can discuss further. Few more ratios are there. Huh? Which one? Equity shareholders divided by number of equity shares. See, profit available to equity shareholders is nothing but net income minus preferred dividend. Thank you. See you in the next class. Assignment is performing ratio analysis for 2 listed Indian companies from the same industry. Preferably, not preferably, compulsorily manufacturing company. Don't take TCS, Infosys, IT companies, bank. Yeah, you have to choose the companies from the same industry without repetition. Suppose Mr. A is selecting 2 companies, means that 2 companies should not be repeated by. Yeah, you have to circulate one Excel sheet, spreadsheet. In that you can record. Somebody take an initiative. Today itself you circulate one Google sheet. In that you can write your company name. Preferably, not preferably, compulsorily, Indian manufacturing listed companies or trading companies. Avoid service companies. Avoid service business organizations, because you may not be having inventory. You may not have so many items for them. Then again, I have to teach you how to calculate ratios of service companies. That is not required. First, you learn what is ratios. Okay. Is it clear? Yeah, once again, I'll send the sheet today or tomorrow. Not Excel sheet, the description sheet of the assignment. Yes,
Yes.
please. You take initiative.
Sir, yes, please.
Anybody
explain.
online has any doubt? We can close
Yes,
it.
sir. We want to know
Thank
about
you.
the assignment. What is the assignment?
Assignment is nothing but doing a ratio analysis for 2 listed Indian manufacturing or trading companies. I'll upload that today or tomorrow in your LMS. Thank you.
Sir, assignment 1 is graded, sir.
Yes, sir. Company comes under Indian Companies Act 2015 only. But there are companies whose shares can be bought and sold by all. Those companies are called as public companies. The purchase and sale of shares are facilitated in a stock exchange. That companies are called as listed companies. Any company listed in either NSE or BSE or in both. No. Quotas are nothing but equity shareholders. Preference shareholders are nothing but they are like a creditor. They want some profit every year. They don't want to take risk. They are not the owners, but they want to get some profit share. If there is no profit, they won't get any dividend. But debenture holders will get interest. So they are hybrid. They are neither debenture holder nor equity shareholder. They are in between. They are not liable. No. If there is a loss, they won't give anything. If there is a profit, first we have to give to them. That also at an agreed rate of dividend, 8%, 10%. That much only you have to give. But equity shareholders will get everything. Promoter and PR. Just to bring it to percentages. Even if you don't find one thing, okay. It will be in decimal. 0.7, 0.5. That gives out of 1 rupee. This gives out of 100 rupees. Your net sales is 200 rupees. Profit is 50 rupees into 100. So you're converting into 100. First question I started, no. 2 companies are there. One company profit is 1 lakh, another company profit 2 lakhs. Simply if you say 2 lakh company is good company means not good. How much sales it made a profit? So I have to convert into common platform. The common platform is percentage. Only for that reason. Only certain formulas are. Yeah. All profitability ratios will have 100. Even if you don't apply, also okay. But you should say 0.0. I mean 0.5, 0.7.
Sir, did you check our assignments?
Hello, madam.
Yes, sir. Did you check our assignments?
First assignment.
Yeah.
Yes.
So when will we get to know our marks?
After checking all the assignments.
Okay,
How
sir.
many days you took to write the assignment?
30 days.
30 days. So 30
Yeah.
days into 120. That much time I need to correct it now. But I don't take that much time. I will give you soon.
Thank you, sir.
Yes. Okay, so we can close it now, online people.
Okay, sir. Thank you.
Anything is there, you can come to WhatsApp or you can call me.
Thank you, sir. Thank you.
Thank you, sir. Thank you.
Thank you, sir.